within 2 meters, with anyone showing symptoms of a respiratory illness such as coughing or sneezing. If you're experiencing flu-like symptoms, we are requesting that you excuse yourself from the room. Please note, when you join the meeting via Zoom, all participants will be placed in the waiting room and your microphone will be muted until the host lets you in the room. You can follow the hearing live via the City's Board of Revision YouTube channel. When your property is called, you will be allowed from the waiting room and permitted to speak with respect to your property. Once you've been heard, you can leave the meeting and continue to watch the hearing live via the City's Board of Revision YouTube channel. If any participants are currently watching the live meeting on YouTube, please mute your audio player now. My name is Lynn Nesbitt and I'm chairing the meeting today. With me in the room is Neil Harden and joining via Zoom is Maurice Therian. Our secretary is Michelle Neepin. And we have 3 different assessors today, Mark Colatruglio, Stephen Lobenstein, and Jonathan Spacek. We will be hearing applications for revision for the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decision with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of Queen's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I'll confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony, followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You'll receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. Use of cell phones is not permitted except by approval by the chair. Okay, so I guess we will swear everybody. We'll swear the first one.
Yeah, I'm just going to put people in the waiting room.
Okay.
We'll start with the assessor. Can you hear me?
I can. Can you guys hear me?
Yeah, I can. Yep. Can you
Perfect.
say your name, please?
Yep, Mark Colatruglio.
Do you affirm that the evidence you're about to give at this hearing should be the truth, the whole truth, and nothing but the truth?
I do.
Thank you. And Mr. Sawyer?
Good morning.
Good morning. Can you state your full name, please?
Adam Sawyer.
And do you affirm that the evidence you're about to give at this hearing should be the truth, the whole truth, and nothing but the truth?
I do.
Welcome, Mr. Colatruglio and Mr. Sawyer. The property is 1566 Pembina Highway, and the issue under appeal is assessment. Is that correct?
Correct.
Okay, Mr. Colatruglio, we'll start with you then.
Sure. The file number is 21-5 roll number 0308-0206-000. The address is 1566 Pembina Highway. The owner is 1566 Pembina Highway Limited. The roll year under appeal is 2021 with a reference date of April 1st of 2018. The assessed value under appeal, $3,204,000. Class code is 60, and the liability of this property is taxable. The parcel usage is as a commercial strip mall, one building, built in 2019, so a newer construction. The zoning there, C2, community zoning, commercial community zoning. Total land area, 29,227 square feet. The plan area, 8,656 square feet. And the leasable area of the property, 8,565 square feet. If you flip to page 2 of the brief, you'll see that because this is a new property, we don't have request for income information quite yet for this property. We are expecting to get some for subsequent years. Should have a request starting for 2020, but we don't have anything relevant to the April 1st of 2018 reference date for this property. There is some sales that are part of the subject history, though they're not very relevant for the discussion today for the current improvements that are there. Again, because we don't have the request for income information, we don't have any subject property leases to show in the brief. If you flip to page 3 of the brief, you'll see kind of the location of the parcel. This is located directly on Pembina Highway. It says, if you flip to page 3, you'll see the street view and the rear view as taken from Google. They drove by while this was still under construction. If you look at the applicant's brief, they have more current pictures. But this is what was there when Google sent the car by. If you flip to page 5 of the brief, you'll see a variety of rental comparables. The focus here was trying to select comparable properties along Pembina Highway that are newer in age because of the newness of the subject property. And here you can see that there is a variety of rents ranging from as low as $25 net rent a square foot to as high as $30 a square foot. If you flip to page 6 of the brief, you'll see the income workup as applied by the model. The rental rates range from $24.47 up to $28.17. The variation in rents is a result of the different sizes for each of the premises. But once again, the total leasable area, 8,565 square feet. And the total potential rent here, $220,492. The model applies a 4% vacancy, market vacancy. The effective gross income then is $211,672. The city applies a 2% non-recoverable expense allowance and shortfall at $7 a square foot to arrive at a net operating income of $205,041. The modeled cap rate, 6.40%. For a capitalized and rounded value at $3,204,000. If you flip to page 7 of the brief, you'll just again see a summary of the income workup. Page 8 of the brief is our cap rate table. So you'll notice that this property falls under the retail property type, and it would fall under the strip mall usage. The city reports a range of 5.4 to 8.65 for cap rates, but the 20th and 80th percentile range is 6.40 to 7.05. So this property falling in at the 6.40 falls on the low end of that range between the 20th and 80th percentile. Things like age, size, location all play into the cap rate. This being a newer property falls on the lower end of that range. If you look at the outside sources, Collier's Q1 report shows a range between 6 and 6.75. So again, we're within that range. CBRE shows 6.5 to 7.5, so just under the low end that CBRE reports. And Cushman & Wakefield shows 5.75 to 7%. So again, within the range at the 6.40. Page 9 is just some excerpts from the Municipal Assessment Act. And page 10 through to the back of the brief is our standard 2020 reassessment addenda package. This covers some of the some additional cap rate evidence, as well as a look at some of the work that went into the non-recoverable expense sampling. The city did, in previous cycles, give a larger allowance for non-recoverable expenses. Through the 2020 reassessment, it was determined that through an expense allowance, non-recoverable expense allowance sampling, we were able to determine that the amount was actually lower. So there was a change in that. Prior, it used to be 7% total. Now it's just 2%. So any property within the city would have been given that expense allowance, the 2% as opposed to the 7% that was given in previous cycles. And any properties that were not appealed were obviously applied the 2% as opposed to 7%. That is kind of my presentation for this property. If you have any questions, I'm open to answering.
Thank you, Mr. Colatruglio. Mr. Sawyer, do you have any questions?
Yeah, I do. Thanks, Mark. A couple questions for you. Have you driven by the property?
I have.
Okay. Did you access the property southbound or northbound when driving down Pembina?
I believe I was heading north.
Okay. So the reason I ask is because heading northbound, when you turn into the property on Crescent Drive, it's a pretty tough entrance to a retail strip. You have to take a U-turn. It's a very, very busy, it is signaled, but it is a very, very busy intersection, and it's a tough turn. My next question is pertaining to vacancy. I think you and I previously discussed we're on the same page as in terms of our rent comparables. So I don't really have any questions on that, and I just want to move on to your vacancy rate that you use. So where did you select 4% from?
So again, that's a modeled vacancy rate. So we would have done a review of strip mall properties, and we would have done a review for strip mall kind of by market region within the city. In this instance, this market region, this type of property, 4% is the vacancy rate that we've calculated from the information provided to us, the income and expense information provided by other property owners of similar properties within the city.
Okay, so do you take into consideration lease up at all of a property like this that's a new construction build?
Typically, no. So we would divert to the market vacancy until we see that there is some sort of issue of chronic vacancy before we look at making an adjustment to the vacancy rate here. It is normal with new construction that there is a bit of a lease up period. From what I could see, it didn't look like there was any big gaps in the vacancy here. But yeah, we're talking about 4%. I think you had 6%. It's fairly close. But yeah, we don't go above and beyond what the model would suggest for a market vacancy until we see issues arise of chronic vacancy.
So when you're inputting this into the model, you're only considering a broad overview of vacancy for all strip types. Are you looking at new strip malls? Are you looking at old strip malls? Are you looking at everything blended? Are you looking at rental rates that may affect vacancy?
So the analysis would happen based on the property type and the area. So I think it does lump in all of the different ages and various rents that are in place. I'm not 100% certain on the actual analysis in the model to determine whether it's new or old and whether that plays in. But like I said, it does go to a market allowance for vacancy.
Okay, so when you selected a rental rate here, which blended for all unit types, we have at $25.75. Would you consider that to be at the low end, the middle end, or the high end of the market?
Well, I mean, based on the comparables that I've selected, it's within range of the newer construction within the area of similar property. But because it is newer inventory, typically it would fall on the higher end of the range. Older properties typically aren't going to have as strong of rents. But yeah, it does fall within range that you would expect for the newer construction within the area.
Right. So I would say that this definitely falls in the high end of retail and rental rates for commercial properties overall in the city. And that being said, would you agree that there's therefore a smaller tenant pool within the city to select from at this high end of the range?
Hard to say, right? There's all sorts of different folks that are looking for space at all sorts of different periods of time. Whether it makes the space less desirable, I think some folks would be hesitant to go into older space. They may prefer newer space. But it's hard for me to speak to each individual prospective tenant that would be looking at the space and see as to what their thoughts are on whether that turns them away from the property or it attracts them to the property.
Any ideas to what type of tenant would be deterred from a higher rental rate like this, or be attracted to a higher rental rate like this? Like, would it be restaurants, physiotherapists, medical use? But
could be any of those things. It could be all sorts of stuff that would go into it. It's pretty standard shell space that could be developed into whatever is needed by the tenant. Mm-hmm. Yeah, it's hard to say which types of tenants specifically, which types of businesses would be attracted to that space. But we've certainly have seen some tenancies or some tenants go into the space. So it's not that they're struggling to find tenants. Yeah, it's hard to say the exact type of tenant that would be attracted to. People are attracted to properties for different reasons. Could be exposure, it could be location, it could be all sorts of things.
Right. So. Are you aware that the subject property started operation in June of 2019 and was 70% vacant until the end of the year?
Yeah, I mean, I'm aware that they started leasing up after construction was finished. As to the individual vacancy on a month-to-month basis, we don't really track that stuff. We would track as tenants go in and apply for occupancy, we would add them into our records. But yeah, there may have been a period where there was higher vacancy just as a result of it being so new to the market. But yeah, since then, I mean, they've definitely have some tenants that have moved into the space and are occupying there.
Mm-hmm. And in just 2 years, are you aware of any turnover that's occurred within the building?
I think when we spoke, you did mention that there was turnover of one of the larger units. From what I can see now, it doesn't appear that space is vacant, so they have filled it in. But yeah, other than that, like I said, we would just track based on the occupancy permits and the vacate requests. So if a business moves out and they indicate to us that they've vacated that space, we would then remove them from the city records. Mm-hmm. And if we see an occupancy permit that someone new is moving in, then we would license them into the property for BA purposes.
Okay. And you had mentioned something about shell space and moving in. Are you aware of typical costs for a tenant moving into a shell space like that, or for the landlord for that matter? Yeah,
I mean, obviously there's going to be some build out cost. what individual arrangements are set forth in the leases. We don't typically get a hold of the leases from the owners, and we don't have information requests back from the owner for this property to really say what that arrangement looks like, whether it's something the landlord is covering or whether it's tenants covering. But yes, obviously there's going to be some costs associated with getting the units ready.
Yeah, so there would definitely be costs for building out each unit for a shell space like this, and if the cost is borne by the tenant, that's going to increase their costs, and their rents are already at the very high end of the market, and now you're adding an additional cost to outfit the unit. And I'm wondering if you believe that there's a strong tenant pool out there in the city of Winnipeg for that type of a market, relative to where the other comparables at this 4% vacancy that you've selected from.
I mean, it's hard to say really. At the end of the day, whether it's older space that's been gutted and is sitting vacant, and someone is looking at that space and looking at what they would need to do to fit it up for their business, or looking at new space and looking at the cost of fitting out a space. Hard to say percentage of prospective tenants as to what the attractiveness of new space versus old space and the costs associated with. If it's simple retail, maybe there's not a big difference between fitting up an old space versus a new space. But if you're looking at restaurants or adding in kitchens and stuff, it's really hard to say. Some of the old space has some of that stuff in place already, and then it can be repurposed. Whereas if it's built as a shell and then needs to be furnished out with some of that equipment to run a restaurant or to run a specific type of business, then yeah, each individual tenant is going to look at their situation and look at what their needs are and what each property can offer to them and how that fits into their business.
Right. So looking at each individual tenant then, just for example, if you were a lot of retail strips in Winnipeg, they have medical use as their anchor tenants, or they may have a small grocery store, a 7-Eleven, something like that. If you were a local, say, medical use physiotherapy clinic, would you earn any more income from a property that charges you the high end of the market rent or the middle market rent? So basically the question is, if you're a physiotherapist, and you have the option between a building that's charging $17 a foot compared to a building that's charging $25 a foot, is there a difference in how you would run your business or the income you would project?
Again, hard to say because location definitely plays into it. Exposure definitely plays into it. If you're paying for, if you've rented somewhere that has lower rents but is in a less exposed, I guess, if there's less exposure, or it's in a less high traffic area, then yeah, maybe there is some impact on the income that you're able to bring in. But again, it all depends on the business type and what you're looking for. And if this is a high traffic, right? So you're right on Pembina Highway. If you were somewhere else, if you're off a main route, maybe the rents are cheaper, but maybe you get less foot traffic, or you get less traffic in general driving by the building and seeing your business. And it's hard to say what the impacts is to each individual business and what their revenue would look like as a result of selecting a lower rent space or an older space versus a new, right?
All right. So then I'd like to move on to the next piece here, which is going to be your selection of a 2% expense allowance.
Yep.
So can you tell me a little bit about where that 2% comes from, and is it based on this individual building at 1566 Pembina, or is it a combined expense ratio that you've selected from a pool of buildings?
It's from a pool of buildings. And I mean, if you flip to page 14 of my brief, part of that addenda package is the non-recoverable expense sampling. So you can see that there's a variety of different property types within there, not just retail. There is some industrial thrown into the mix, but obviously there is retail. There is some office space thrown in there. But basically, this was a sampling of properties within the city. We looked at non-recoverable expenses, net of vacancy, shortfall as a percentage of the EGI. And if you look, the total median percentage at the bottom is 1.06%. 2% was ultimately what we used. And that's kind of what was applied citywide across the portfolio of properties being assessed.
And can you point to any new retail strips on this list?
I can't. I haven't gone in depth with each of these properties to say the ages or what's newer, or what's based on the usage code. There's a wide range here, and no, I haven't looked into each one individually to say.
Okay, and you did say that there was a mix of industrial, retail, and office, I believe.
Yep, correct.
Right, and are you of the belief that each of those asset classes would produce the same amount of non-recoverables, or?
Again, it all depends on what the leases look like that are in place there. Typically, if you're talking about net rents, triple net rents, the owners are recovering all of those costs through their leases. Obviously, if the leases aren't triple net, then there may be a mix of, if it's semi-gross or whatever, there may be items that aren't included in the rent. But when we're trying to analyze and when we're trying to put a rental rate down, we're trying to look net rents. So it would be all of that stuff would be typically recovered through a triple net lease.
Mm-hmm. Are there any expenses that are incurred due to a triple net lease? Like in the case of the subject property, we have a building that has no tenants in it at the time of this appraisal, that's in its lease up phase. So I'm wondering if you believe there are any additional costs associated with obtaining tenants for a property like this.
Well, I mean, there would be some sort of advertising. There could be advertising. It depends, right? The property ownership sometimes will go to a leasing agent, and there may be leasing commissions that you see. They may take it upon themselves to market. The costs can vary drastically based on the ownership and their decisions. Some of that stuff is not stuff that we factor into our valuation. Leasing commissions, tenant inducements, that stuff is not, and there has been some case law that suggests that we don't factor that into our analysis. Obviously, none of that stuff is in my brief, but I can speak to it in that there is a wide range, and there may be costs associated. In this particular property, there would be some shortfall, obviously, with any vacant space. But yeah, beyond that, it's hard to say what exactly those added costs would be or what they would look like.
Mm-hmm. When you see a building like this, is it typically constructed by an individual or by a asset management company, a REIT? What do you typically see? There's a range. I mean, this is a fairly big project. It's probably more on the professional end of things. It's not just an individual who's decided to build out a strip mall. But yeah, again, we do see folks that are looking to develop commercial property, and they aren't part of a big REIT or part of a big asset management company. So again, hard to really speculate on for individual properties what the situation is without actually diving into the details. Okay. But if it were to be constructed by a REIT or an asset management group, would there be any additional fees attributed to that? There could be. Like asset management fees, again, we don't include that stuff in our analysis because that is a cost incurred as a result of the ownership structure, not necessarily the operation of the building. So again, that's a business choice by the owner to have an asset manager manage the property and
But yeah, I mean, there absolutely could be different costs associated with different ownership types. So it's just not necessarily included in our analysis.
All right. And then the shortfall allowance of $7 a foot, did that come from the actual CAM and tax from the building's operation, or is that just a projected number?
That's again modeled. A problem with this property and using the actual information is the building didn't come online until 2019. So anything actual from the building is post-reference. So again, we're reverting back to information reported to us by property owners of similar properties and looking at what their shortfall costs are when we're developing the model. And then that gets applied based on the property type and location and that sort of stuff. So it's not specific to this property, if that's what you're asking.
Right. And would $7 fall at the low end, the middle end, the high end of the range for retail strips?
I believe that's pretty standard, so pretty average.
Okay. And then would a property that's taking in rental rates at the high end of the range, would that then increase the value of the property, which would incur a higher property tax rate?
Yep, absolutely.
Yeah. And so then shouldn't the shortfall allowance be indicative of that by showing a higher CAM and tax?
Again, the shortfall is kind of a mechanism of the vacancy, right? So if the vacancy is low, the shortfall is not a huge concern for the ownership. But yeah, I mean, if you're looking at specific expenses to the owner, property tax absolutely is an expense. But again, it's typically recovered through their leases on net leases, right? So, yeah, hard to really say what the impact would be on a per square foot basis for the shortfall. The $7 is our modeled rate, so
yeah,
that's what we've used today. Yep.
Sorry to interrupt, but you say that the property tax would be recovered by the tenant. However, shortfall, just so the board is aware, the shortfall is actually for a vacancy in a unit. So it's stating that if there's a vacancy in the unit, then therefore, because the tenant is not in place to pay the property tax, that tax is then borne by the landlord. So that's why we put in a shortfall allowance is to take the vacancy, which you've used 4%, and then we take that percentage and apply it to what we would consider to be a budgeted or projected common area maintenance and tax. So I just want to make that clear that it's not recoverable. Yeah. Okay.
Yeah, if there's no tenant, not recoverable. Absolutely.
Right. And if there's no tenant, of course, it's not recoverable, but the shortfall allowance is taking into consideration of that already. I just want to make that clear. Yeah. Okay. And then the final point is on your cap rate selection. So tell me how you came to decide on your cap rate and why you chose to go with the 20th percentile.
Again, so with this analysis of sales of strip mall property types, we see a range between 5.4 and 8.65. But again, typically when you're looking at a bell curve, there's the two areas on the outliers on each side of the curve that you'd kind of classify as outlier information. So you would look more to between the 20th and 80th percentile in regards to this specific property. So there's many things that play into the cap rate. Location, size, and age are big contributors to the cap rate and how it gets selected within the model. This property being so new, typically would shift that to the lower end of the range. So that's what you're seeing here is it's at the 6.40, and it is supported by some of the outside sources, barring CBRE, which is slightly higher on the low end of their range.
So you talk about the age, and that's why it would be on the lower end. Why is that, in your opinion?
Well, the property typically isn't really in need of a whole lot of work if it's brand new. There isn't as much, I guess, risk associated with taking on that property and finding out that there's all sorts of deficiencies that need to be repaired. The property is very attractive in the market if it's new because it is new. Typically we would associate that with lower risk. So that's, the lower rates you see as a result of that.
So that's the key word, is risk, right? And when we're talking about a new building like this, that at the date of reference was not fully constructed, did not have any leases in place, is going to be at the high end of the market with a smaller tenant pool, as we've sort of discussed. I'm wondering where the less risk factors in terms of anything other than its new condition.
I don't necessarily agree that the tenant pool is reduced because it's newer. I mean, maybe by mechanism of the rent being higher, some folks would be less inclined to pay there. But again, some people are attracted to newer space in the market. So it's I don't know necessarily that it affects the tenant pool that's available to the property. But again, just risk associated with buying and owning and operating this property is lower because it's newer. That's really what it comes down to.
What about revenue potential for a property? Is that considered in your analysis of cap rates?
Revenue potential in that someone looking at a property looks to grow the revenue through new leases as they expire, getting new leases in place. Mm-hmm. Well, we would look at each individual sale, kind of look at the age and the leases that are in place for those properties. In a newer property, obviously, there's not a lot of income growth potential, though there may have been step-up leases and stuff that were signed. And again, hard to say without seeing the leases themselves. But there are purchasers that look at, this building has majority older leases, and we can move in, and as these leases expire, put some money into the property and bring them up to a higher level of income. Mm-hmm. With a new property, you don't really have that. But again, you're not really needing to put any money into the property either to kind of capture a greater rent out of the market, because it's new, it's ready to go.
You say you don't have to put any money into the property because it's new, but when we were talking about the 2% expense that you put on, we did discuss how there are potentially additional fees that you would incur due to the fact that it's new, such as marketing, leasing, and things like that, legal fees. So is that taken into consideration?
No, and part of it is that there is case laws that suggest that we don't include that stuff in our analysis. And when you're looking at calculating an NOI in Manitoba, we do have cases in the past where tenant inducements, leasing commissions, that stuff was removed from the analysis and was determined from the boards, the municipal boards, that it's not to be included in our calculation of the net operating incomes. So no, we don't factor those additional asset management, again, a cost associated with a specific type of ownership. So some of it is business decisions, some of it is ownership related costs, not necessarily tied to the operation of the building itself.
So is the case law that you're referencing, is that referring to new retail strips, or is that referring to all retail strips or old retail strips?
Well, it's hard. It's without having the orders in front of me, and it's not in my evidence. So we're not able to read the orders, but I can tell you that the board kind of looks at properties. They call it hearing de novo. They look at each property kind of in isolation of others. But some of the valuation principles that come out of those decisions kind of guide the city's action. So no, it's not something that we've included in the analysis.
Okay. And so we talked about the potential for increasing revenue, which would decrease the cap rate because it increases your NOI. What about decreasing expenses? So if a investor is looking at a commercial property like this, you can look at it for its future potential net operating income by either increasing the expenses or increasing the revenue or decreasing expenses. So is there any potential here to decrease expenses in the future for a property like this?
Yeah, hard to say.
Mm-hmm.
I mean, maybe, it's hard for me to say. I'm not privy to the leases that are in place, so I don't know exactly how they divvy up expenses to the tenants and but when we're modeling, it's based on net information. So we're assuming that all the CAM costs are recovered through the lease to calculate the NOI that we arrive at.
Mm-hmm.
So again, for a prospective buyer, hard for me to comment on how they may navigate. Like I don't buy and sell commercial properties. I'm not quite certain as to how a prospective buyer would look at this and say, okay, we can reduce expenses via this, or we can increase rents via this, right? I mean, at the end of the day, they may have a plan for a property. They may have more room to look at expenses and look at revenue through older properties versus newer properties, but hard for me to comment on.
Mm-hmm. So speaking of prospective buyers, the question starts with, are there any comparable sales of newly constructed retail strips on a major corridor in the city of Winnipeg that have sold prior to leasing?
That's in my brief? No.
Or that you're aware of?
No. I mean, if there was something that I was trying to suggest was a pertinent piece of evidence, it would have been in the brief.
Mm-hmm.
I haven't reviewed every single strip mall sale within the city to say that there are newer ones that have sold. I mean, typically, if we're just speaking kind of generally, I don't think we would. A lot of new properties, I don't think they build them to sell them. You know what I mean?
Right. No, I agree with you. And so I think that there's no true apples to apples comparables in terms of cap rates for new retail strips in the city of Winnipeg. Would you agree with that?
Yeah, I wouldn't say there's no true. There may be a newer inventory that has sold, but whether it sold immediately after it was constructed, again, without going through every single sale, it's hard to say.
Mm-hmm. So when you don't have true comparables in your analysis, do you look at anything above and beyond sort of these cap rates that are produced by the City of Winnipeg, Colliers, or CBRE? Do you speak to any investment groups, or do you speak to any commercial lenders, anything like that, to get a sense of what a property like this may trade at?
No. So we would just look at sales that we're analyzing, right? So we would go through all of the sales. We do send out sales questionnaires to the new purchasers of all these properties when they do transact on the market. And then we analyze that information and verify what we're looking at for each individual sale.
Okay. All right. I think that's good for my questions. Thank you, Mark.
Thank you, Mr. Sawyer. Mr. Hardy, do you have any questions?
Is this the first assessment for this property?
Yeah, like this is because it's a new property within the city. This was our valuation as a result of adding it onto the roll.
Okay, so this is newly added onto the roll then.
Correct. Yeah.
Okay, and the evidence presented, I don't think it was yours. It came online in June of 19. Is that correct?
Yeah, that sounds right.
All right, no more questions.
Thank you, Mr. Harden. Mr. Tyrion, do you have any questions?
Well, I just want to confirm a few things. This is basically model driven from what I understand. Is that correct?
Correct.
Yeah. And that's a 2019 building. Can you tell us when it became fully occupied? And I assume that's the only tenant in that area. Am I correct?
The only tenant in the area?
Yeah. Is the cafe there, the restaurant? Is that the only tenant in there?
No. So my records show that there's 4 premises total, and one of the spaces is vacant as of our system right now.
Okay. So
The smallest unit being vacant.
Okay, the 8,565 square feet then is made up of how many tenants?
So my records show 4.
4. And
Yep.
there's one vacant at the moment?
Yes, 4 units, 1 vacant, and the smallest unit being vacant.
So do you know the size of the vacant one?
Let me take a peek. I believe it's 912 square feet, but I'm not 100% certain. The brief doesn't show me a distinction between occupied or vacant.
It's about 10.
Just going on the information in front of me, I believe it was the smaller unit, the 912 square feet.
So it's around 10% more or less. Because 8565, it's a little
I gotcha.
a little over 10%. So that is vacant. Do you know since when it's been vacant?
No, again,
Well, the
the property would have,
Yeah, the appellant.
the appellant may know. Yeah, he may know.
Yeah, okay. I think that's all I had. I was trying to get a handle. I was a little confused about the number of tenants, so that's why I wanted to get that clarified. And so your cap rate is basically fixed on location, age, and size. Really, the rest is not much of a factor as far as you were concerned in the 6.40%.
Yeah, I wouldn't say not much of a factor, but the primary kind of,
Okay.
yeah.
Okay, I think that's all I have for now. Thank you.
Yep.
Thank you, Mr. Tyrion. And I have no additional questions. So, Mr. Sawyer, you can proceed with your presentation.
Okay, thank you very much. So as the assessor stated, this is 1566 Pembina Highway, file number 21-5, roll number 0308020600. It's a 4-unit retail strip located on Pembina Highway. It does have good exposure on Pembina. It's a new construction building. Access is gained southbound via Crescent Drive. You have to make a U-turn there, whereas northbound you do have a little bit of better access to it. And I do want to just sort of go right into the analysis here of valuation. So as far as the lease rate analysis goes, I think myself and the assessor are on the same page as far as that. I do believe that this is at the high end of the market. And I do want to discuss a little bit about being at the high end of the market and how that may sort of handcuff a property, especially in the city of Winnipeg. So in looking at retail strips throughout the city of Winnipeg, what we typically see are anchor tenants such as for medical use, so physiotherapists, massage therapists, dental clinics, things like that. For instance, somebody like a physiotherapist, they have many options as to where they may want to rent within the city, but they don't really have too many options of what they can charge their clientele. So if you go to a massage therapist, you're pretty much capped out at a certain dollar amount. So for them, they say, well, do we want to be paying 25% more in rent when we're still making the same amount of revenue? It just doesn't make much sense. So typically, a retail strip like this is marketing towards new restaurants. They do have this particular strip mall at 1566 Pembina Highway is in fact occupied by 3 restaurants. And then more recently, I believe, a cannabis dealer that sells marijuana. So those are the types of tenants that go into a building like this. It is not a broad overall tenant pool that you can go after at such high rental rates. It's very difficult for a business to survive in this city when they have options and their competition is in buildings that are costing them 25 to 50% less. So in doing so, you have a smaller tenant pool, which therefore would make it more difficult to fill the building, to start to lease up the building, and also more difficult to lease the building when there's turnover. So when we're looking at vacancy, I'm looking at comparable buildings that we have in our database, and then we also use the Johnson report to look at vacancy rates. And the overall vacancy for retail strips was 5.9%, and that's average vacancy. So that takes into account all age classifications, all locations. It takes into consideration also where the rental rates are at for these comparable buildings. So as an appraiser, I look at a building like this and I think, where is vacancy going to be on a building like this over the next 5 years, 10 years, 25 years? And as mentioned, the building itself was 70% vacant for the first 6 months of operating, which shows that it was very difficult to lease up the building prior to it being constructed. And it also shows that there is, in fact, a smaller tenant pool out there for rental rates at this high of a rate. As well, above and beyond these triple net leases are tenant improvements that need to be done. And those are often borne by the landlord, but they're also often borne by the tenant. And there's usually, it is very dependent on the individual circumstance, but it is an additional cost. So it just continues to decrease the tenant pool out there who's willing to pay such high rental rates. So looking at the 5.9% average, we determined that it should be slightly above this at 6%. So pretty much in line with 5.9%. I'm looking at this building thinking you've got the potential for high turnover, which we've actually seen turnover in the first 2 years of operation. We have one unit, which is over 5,000 square feet, which is about 60% of the building. If that unit is to go vacant, which it has actually already turned over once, that is a massive vacancy for the property. Even as discussed prior, the one vacancy that's in the building right now at 912 square feet is 10% of, a little over 10% of the property. So on an ongoing basis for a property like this, I think it's actually very reasonable to conclude a 6% vacancy rate. The other sort of sticking point that we have is with the expense allowance here. So I do agree with Mark that for many buildings in the city, and including industrial buildings, definitely industrial buildings, 2% allowance is fair for a single tenant property. What the 2% allowance doesn't take into account is, for a property such as the subject, is the fact that it's brand new. It takes a ton of money to market the property. It takes a lot of money to put the leases in place through commissions and also through legal fees. And this is not something that's taken into consideration in the assessor's brief. We talked about tenant improvements. So if you look on page 12 of my brief, there is a breakdown of different expenses that are not included in the assessor's brief that I would consider to be very standard for a property such as subject. Keeping in mind that a property like this would most often be constructed and owned by an asset management firm or a REIT, that a property such as this to construct is very expensive for an individual to construct and also to manage. So it's not the assessor's brief is not taking into tenant improvements that we've discussed. It's not taking into leasing commissions that would be on the high end due to the fact that the rental rates are also at the high end. And it's also not taking into consideration asset management or professional fees as well. The city of Winnipeg recently decided to take away this expense allowance at 5%. And although I believe it may even be higher than 5%, we think a fair indication of the property is 5% expense allowance for these professional fees, asset management fees, tenant improvements and leasing commissions above and beyond the 2% expense allowance that would be for capital improvements. So I just want to make it clear that a property like this is not something that's going to be constructed by an individual real estate investor. This is something that is at the high end of the market. It takes a tremendous amount of work to find a site like this. The site was previously occupied, I believe, by a gas station. It took a lot of work to get it rezoned, to get permits for construction. This is not a project that would typically be taken on by an individual, and therefore there are many additional expenses that are borne by the developer. As far as the shortfall allowance goes, I'm a little bit higher than the assessor, and we've based ours on the actual CAM tax that's been presented by the owner from 2019 and 2020, and this includes all recoverables. So this is above and beyond what we would consider to be triple net leases. So we're slightly higher at $9.55. And if we go to page 13 of my brief, you will see a breakdown of our net operating income. So we have the same lease rate, same blended rates as the city of Winnipeg, a slightly higher vacancy at 6%. We then have a shortfall allowance at, before I move ahead, we have an expense allowance of 7% as opposed to 2%, which I've touched on, and also the shortfall allowance of $9.55 a square foot, which is slightly higher than what the city is showing for a net operating income of $187,896. As far as the cap rate goes, as I mentioned, there's really no true comparables in the market today for a building that is under construction that is not fully leased, especially for retail strips. We've seen some transactions of newly constructed apartment buildings that haven't leased up yet, but as far as retail strips, I'm unaware of any retail strips that have transacted at the point of where the subject property was at the date of reference. So what we need to do as a valuation expert is we need to look at many factors. We need to look at comparable sales, so comparable cap rates of retail strips of all different ages. And then we also need to look at where the market is today in terms of where are interest rates at, where are investors seeking alternative options, where are banks willing to finance a property like this at. And if we look at a brief comparable study of capitalization rates, we can see that retail strips in 2015, 16, and 18 all are above the 7% mark. We also do look at the city's briefs, and we also look at CBRE and Collier's and Cushman market overviews, which the city has included in their brief. And I believe that due to everything we've discussed here today, as far as the high rental rates in the building, the smaller tenant pool, and the fact that the building took 6 months to even lease up fully, the high vacancy rates, that this property, although new, and although a new property does incur lower expenses, the risk associated with a new property is what we need to focus on here. So the risk associated with a property like this is tenant turnover, being able to actually recover expenses such as the commissions, the legal fees, the development costs, things like that, that are all taken into consideration for our capitalization rate, which we've capped at 7%. So at that 7%, we come to a final value of $2,684,000 rounded, and that's where I believe this property falls in line. So I'll leave it at that.
Thank you, Mr. Sawyer. Mr. Colatruglio, do you have any questions?
I do have some questions.
Mm-hmm.
In your presentation, you referenced a cannabis retailer that had gone into the building. Did that, with that additional tenant, did that create full occupancy here?
I believe so, but I need to look into this a little bit further. So there was actually a tenant turnover. I believe they started as a bubble tea restaurant, and that tenant actually went vacant. So that was another turnover that they had, and I believe that they have since occupied it with a cannabis retailer.
Okay, gotcha. Yeah. So as of right now, they've got full tenancy in the building. Our records did not have the cannabis retailer, so that was where we're showing the 912 square feet as vacant. We haven't licensed those folks in yet. So yeah, just do you know when that tenant moved into the property?
No, I do not. So
Okay.
I can tell you though that it was, let me just see here. It was definitely not prior to 2020.
Okay, so sometime this year they went in.
I believe so.
Gotcha. So as of right now, they've got full tenancies, but it took them a couple of years, basically, to kind of.
Well, full tenancy, but I want to reiterate the fact that in just 2 years of operation, they've had turnover of 2 different tenants. And that in itself, when you have any turnover, there's going to be vacancy between the tenant coming in and the tenant leaving. And also, because of the turnover, now you're incurring extra commission costs, legal fees, outfitting of the units. So you don't want turnover in a building, even if it's fully occupied.
Right, but yeah, it certainly is a good sign that they were able to fill the spaces following the turnover, right? Probably
Correct.
better to incur those costs than to have the building sit vacant, right?
That depends on the type of lease you're able to get. And in today's market, with everything that's going on in terms of retail, I'm not sure how this lease is broken down or what kind of government subsidies they've been generating. So definitely better to be occupied, but it just shows that there is more risk to a property like this because of the fact that there's so much turnover in only 2 years.
Right. Okay. So in regards to the shortfall rate that you've selected, you referenced that was from the actuals that were provided for 2019 and 2020, correct?
Correct.
So that would be information that's kind of post-reference, right? In regards to the April 1st, 2018 reference date?
Correct. The 2019 budget for the owner is budgeted because it didn't come into operation until June of that year, and then also they didn't have full occupancy. But that's the $9.55 is based on actuals. Sorry, I should clarify this. It's based on actuals from 2021, 2020, and also budgeted from 2019, and it's a blended rate of the two.
Gotcha.
Yeah.
Right, and we wouldn't really have any information to analyze that would be prior to the reference date, right?
Correct.
Okay, and then in regards to the cap rates that you provided on page 14, are any of those newer properties of those 5 sales?
The best comparable, I would say, is comparable number 1, which is at the corner of Osborne and Stradbrook. Although it is not a new building per se, it had significant renovations completed to it. So as mentioned before, there really are no true comparable sales of buildings that are mid-construction, that are not leased up fully for us to go off of. So it's important to look at these sales, but also look at the overall market and where, sort of the minds of investors are at in terms of their risk profile and alternative investments.
Right. Now, the sale here, are these all strip mall retail, or is this a mixed bag of retail?
So they're all stripped with the exception of comparable 2.
Okay. And I know Osborne, depending on the property, parking can be a concern. This does have on-site parking, similar to the subject.
So comparable number 1, yes, it does.
Yep.
Yep. And then comparable number 3, I don't believe so. Keeping in mind, though, that I would argue that the foot traffic on Osborne compared to the foot traffic at 1566 Pembina Highway sort of balances out to the lack of parking.
Okay. I have no further questions.
Thank you. Mr. Harden, do you have any questions?
Just on your vacancy, in your brief, you state that the Johnson report for the year in 2017 states average strip center retail vacancy at 3.9%.
Mm-hmm.
And then you're saying overall retail vacancy of 5.9. So that would include the overall would include the very large properties such as the vacant Target store and places like that, would it not?
I believe so. It would include all retail. So in 2017, I can't remember offhand whether or not that's when Target would have been vacant, but it would include that. Yes.
Okay. So why should we use the overall versus the strip mall vacancy rate?
So for me, it's a bit of a blend here because, like I said, the Johnson report includes all retails of all different ages and all different rental types, and that's really what I want to focus on is the tenant pool for a property such as this is at the very high end of the market. Is that it's much harder to find a tenant to fill a building such as this and to maintain a tenant such as this compared to the other properties that would be included in the Johnson report. So as an appraiser, I look at a number like 3.9% for the overall universe of retail buildings. And I need to critically think about how a property like our subject would fall into this category of a broad overall universe. So I think it's important to look at retail strips, the overall vacancy rate, but also the individual building itself and what type of tenants it would attract and what type of tenant pool is out there. And then as well as the fact that the subject property was in the lease up stage of development.
Okay, no further questions.
Thank you. Mr. Tyrion, do you have any questions?
Just a few. Again, I'm getting back at the vacancy. The evidence is that it's now occupied. Would you, I know, and you talked about a lot of turnover. Would you have any idea of how much vacancy there was in that period? You may not have it, but I'm just trying to get a handle on that a little better.
I don't have the exact amount of months in front of me here. But no, you know what, I'm sorry, I don't have the amount of months, but there is going to be a period between the tenants from moving out to finding a new tenant, and as well as to outfit the particular unit. So it's definitely not close the door one day, open it up to a tenant the next day kind of deal.
Okay, that's fine. I was just trying to get a little more. The other point is, it's not a big amount, but I'm looking at the shortfall, and the shortfall is obviously tied into vacancy. Now, I'm always wondering if we allow more vacancy, isn't that sort of double dipping when you also go into the shortfall amount? That's a little bit the concern I'm looking at, I guess, to understand a little better, because
yes,
the shortfall is tied to vacancy. So when you go to vacancy, well, and you get it, let's say you get more, but then you want also more on the shortfall. Could you clarify this for me, please?
definitely. I want to make sure that we're separating the two, because you have vacancy in a property that you're stabilizing. So you're saying that on a stabilized basis, this property is going to have, in our instance, 6% vacancy due to turnover and bad debt as well. So it takes into consideration, vacancy, bad debt, and turnover. Okay. The CAM and tax amount is something that is going to be at a stable level, regardless if there's full occupancy or regardless if it's fully vacant. So the CAM and tax takes into consideration what it costs the landlord to run the building. So if you have a full occupancy of the building, your tax amount is going to remain the same as what it would be on a stabilized basis if it was fully vacant. And then your common area maintenance fees, such as your utilities, are also going to remain the same. This is due to the fact that we're looking at triple net leases. So let's just take, for instance, into consideration a hydro bill, which would be part of CAM. Your hydro bill, while the building is occupied, is going to be paid for by the tenant. Now, if that unit goes vacant, you still need to keep the space heated, and you need to keep lights on for security. So you're still going to incur a utility expense. However, that expense can't be passed off to the tenant. So regardless if there is a tenant or not in the building, your utilities are going to remain the same. It just is dependent on whether or not the tenant is going to be the one paying for it, or the landlord has to pay for it due to vacancy. So the CAM and tax will always pretty much remain the same. It's just the fluctuation of vacancy that changes. So we're using a stabilized vacancy rate, which we've already shown, sort of proven out, so to speak. And then we're using an actual CAM that if there was a vacancy, that's the amount that the landlord would then have to pay, as opposed to the tenant paying.
Okay, that's helpful. Thank you.
Mm-hmm.
I'm done, Madam Chair. Thank you.
Thank you, Mr. Tyrion, and I have no further questions. So thank you very much, Mr. Sawyer and Mr. Coglio, and you'll have our decision.
Thank you, guys. Have a great day.
Much. Have a good day.
Yeah, we're just going to take a little 5-minute break, and then we'll carry on. Okay, I'd like to call this meeting back to order, please. We're now going to be dealing with 1555 La Jamodier Boulevard, and we will first swear in the applicant and the assessor. We'll start with the assessor. Can you state your full name, please?
My name is Jonathan Spacek.
Do you affirm that the evidence you're about to give at this hearing should be the truth, the whole truth, and nothing but the truth?
I do.
Thank you. And the applicant, can you state your full name, please?
Rocky Neufeld?
Do you affirm that the evidence you're about to give at this hearing should be the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Thank you. And just to confirm today that the issue under appeal is assessed value, is that correct?
Yes, it is.
Okay, thank you. All right, Mr. Spacek, then we'll start with you. Thank you.
All right, thank you very much. Today we're looking at roll number 0400713740. The address is 1555 La Jamodier Boulevard. This is a brand new Hyundai Focus dealership. The lot of land they built on and where it's located is on the corner of La Jamodier and Almy Avenue. This is just north of Reinders Drive. We have a 2020 assessment. It was finished, built effective around July 16th, 2020. And our 2020 assessment is $4,993,000. So again, this is a dealership built in 2020. It has a plan area of 20,561 square feet, but with the mezzanine floor inside, that adds approximately 5,000 square feet or so. It's the total leasable area of this property is 26,430. And if you turn to my page 2, you'll see a picture of the property, a picture of the dealership. The bottom of page 2 is the land that was purchased and built upon by the dealership. If you turn to page 3, you'll see we have no income and expense mailer, as it is a new build, so there's no years of information yet, but you can see the subject land sold September 18th, 2018 for $3,500,000. Again, owner-occupied property. There's no
Sorry,
subject leases.
I'd like to object to this information at this point.
Okay.
I'm wondering if we could just remove that.
Oh, sorry. That is my fault. September 18th. We're looking at that was an accident. Sorry. We just ignore that. It's post-reference. The reference is April 1st, 2018. So please ignore that on page 3. If we turn to my page 4, we have the income stream that derives the full value of this property for 2020. So we can see we have a full all 26,430 square feet with a rent of $14.19. Again, a model-driven rate for our VCD vehicle dealerships. You'll see down we have a vacancy loss of 2% for all of our dealerships in 2020. Under that, we have our 2% non-recoverable expenses at 2% for 2020, shortfall of $6, and an overall capitalization rate of 7.15%. This derives that total value, again, of $4,993,000. If you turn to my page 5, I've included some rental comparables. As we've had these before through the 2020 cycle, there are no net leases for these for full dealerships. What I have done is put together just a list of some rental comparables using larger square footage retail properties. I have thrown some in here that were on Regent Avenue and Nairn, so trying to stay as close to the subject property as possible, but trying to find a similar type of building that could give us an idea of, is that $14 rental rate reasonable or not. So you'll see my comparable 3 is 1080 Nairn. This is a retail location, a 14,000 square foot building built in 2007, has a net lease of $14. You'll see comparable 8 is 1580 Regent Ave. So this is a 25,000 square foot retail building located on right near the corner of Regent and Lage, which is near our subject property, and it has rental rate of $20 a square foot. You'll see comparable 10, 1570 Unit A, Regent Avenue West. This is a retail building built in 2000, 21,000 square feet, leasing for $16 a square foot. Comparable 15, you'll see 1580 Regent, unit 20, was built in 2001. It has 39,000 square feet, so a large retail unit near the subject location. It rents for $15.65. I've included some more comparables, 18, 19, and 26 along Regent as well. You can see those, but these again are just larger retail warehouses in the local area, as we have no, new dealerships with rental rates in the area. So that is where my list of rental comparables are. You can see that on page 5. And just so you know, our property is approximately 26,000 square feet in size. Page 6 is just a income value summary. It's the same income stream since we only have one. If you turn to page 7, we have our standard capitalization rates that you've seen before for the 2020 cycle. You will notice there is no line for brand new car dealerships, but again, these, the closest capitalization rates to use for comparable, you can see on the retail rows, about halfway down the page. You can see, if you're looking at power centers, so it's something like right by Kildonan Place there, you'll see that cap rates for these power centers range from 6.15 to 9.4%, and you'll see that that 20th to 80th percentile range of 7.15 to 7.3%. Our subject property is model driven at dealerships for 7.15% for 2020. And if you scroll down, I've included some photographs on page 9. You can see the pictures of the property. Starting on page 9, there's 4 pictures. You can see the service garage bay. You can see the main floor. You can see the service section. You can see the actual showroom. Page 10, some more pictures. You can see some of that mezz space, break room, storage rooms. You can just get an idea of the quality of the space. And page 11 forward is our added 2020 addenda information. So that is my presentation. If you have any questions on this property, please let me know. Thank you.
Thank you, Mr. Spatchen. Mr. Neufeld, do you have any questions?
Yes, I do. Firstly, although the assessor did acknowledge the sale shouldn't have been in there, it was brought up. Now, I'm very limited question here. Do you know anything about what happened in that sale?
I just have the review of the sale, and from what the review showed, it was an arm's length sale, and then the land was bought and then built upon. That was my understanding of it, but I did not notice that it was post-reference. Okay,
but so you weren't aware of the undue pressure on it, in fact, that it really didn't represent.
The sale itself is post-reference, so don't believe we should be discussing it at all. It shouldn't have been in the report at all.
Yes, so we can't unhear what's been heard.
We will be disregarding it though.
Okay. The comparables I note are all retail. Is that correct?
That is correct.
Did you have a chance to review the building itself and the occupancy permit?
Review the building, I did, yes.
Now, the building, did you review the building code that was used to make the building? And I have included that on my page 5, that this is in a city permit. Did you see
occupancy permit? Yes, I've seen the occupancy permit.
And are you aware that the occupancy permit is based on a medium hazard industrial occupancy?
For the same as all other dealerships?
I just asked, you're aware that it's an industrial building on the permit?
I don't believe it's an industrial building. What do you mean?
That the building class, the construction of it, the occupancy permit is based on industrial standards from the city of Winnipeg. You aware of that?
I am aware of the occupancy permit, and that is occupancy class E F2.
Your other buildings that you brought in as comparables on page 5, do any of them have a similar building classification?
For their occupancy permit? No, I believe they are retail occupancies. Like they don't have the spray painting operations or the repair garage service station portion that requires that change in occupancy class.
is not another factor in the change in occupancy class, the human load, people load?
That could be part of it. I am unaware of the difference in human load.
And what about the parking requirements? Does that not differ?
For the occupancy permit, I'm not sure of the difference for parking between a dealership and a retail.
You didn't examine the city bylaw on parking?
I am, somewhat aware of it, but I did not go in depth in it for this to see the differences in between the occupancy permits.
Well, are there not different requirements for parking under the parking bylaw for an industrial building versus a retail building?
There could be. I have not included any of that in my brief. I am not sure where you're getting it from.
Okay, it's just general information on preparing evaluation. You have, and on page 5, you mentioned that you discussed a few of these, but the rest of these are located all around the city of Winnipeg, correct?
Yes.
And the one where you have several examples, 1580 Regent, that is the power center, is that correct?
Yeah, it's a corner. It's on the southeast corner of Lage and Regent, around there.
And there are anchor tenants and pad sites, correct?
Yes, absolutely.
And there's a range of rents in that site, are there not?
Yes, absolutely.
And do you know what that range is?
Offhand, no, just what I've included.
Okay, well, for example, is Home Depot one of these comparables?
Home Depot is not one of these, no.
Okay. And you mentioned the cap source. Is that similar to a power center? Is that what you said?
Well, I just said the closest power center is Kildonan Place there, like for retail comparables. And for the cap rate, I just was pointing out that the power center range was 6.15 to 9.4, with the 20th percentile being 7.15 to 7.3. Again, we don't have a VCD cap rate row, so I was just trying to show the range of larger retail buildings nearby.
Okay, but predominant, but is it in the city's model that you rely on the retail numbers?
You know what? I'm assuming. I am not sure what modeling does to determine the actual final VCD cap rate.
In automobile dealers, you mentioned there was a lack of rental information. Does that mean that there's a lack of cap rate information as well?
For dealerships, yeah, in general, there is definitely less than, let's say, retail properties.
So in the application of a cap rate, then, what you're essentially doing is establishing a hypothetical rate based on other industry types, then, correct?
Similar to that, yes. Just trying to get a idea of what it would be for a newer dealership.
And the shortfall rate, is this specific to auto dealers?
The shortfall rate, I'm not sure if it's separate, to be honest, the $6, if which shortfall, like the model it's exactly pulling it from, but I believe the $6 is standard across all the dealerships.
Okay, so but that's a model-driven rate?
Yes, absolutely.
Now, as it relates to the subject, did you do any estimates of what the subject's shortfall might be?
No, I have, again, not even a mailer for the property yet.
Well, no, but what about an estimate? Any thought of comparing this to an estimate of what the shortfalls might be?
I did not look at the site-specific shortfall for this property.
Okay. And I take it that inspection was probably fairly difficult and it wasn't done?
I did not do an inspection, no, but since it was recently added to the role, I went off the notes.
Okay. Those are my questions. Thank you.
Mr. Neufeld. Mr. Harden, do you have any questions?
Okay, just, I guess, on your rental rate. Now, as I understand it, this, typically of auto dealerships, there's a showroom area, and then there's the service areas and whatnot. consider breaking down those? Wouldn't the service areas have a lesser rental rate than the showrooms, which would be built out to a fancier standard?
Yeah, I mean, it could be the differences in the actual like rent per area. We don't have net rents for these types of properties to see if they're, they're all rented together as one large space and they can split it up however they'd like, especially when they build it. So we just have a blended rate across all the leasable square footage of 1419. So you can look at that as, the second floor being a little lower, and then the main floor, like, you can break up that 1419 however you'd like, but our model generated rate for the whole area is 1419.
Okay, and that's based on a retail rate where perhaps depending upon the store, it might not be as fancy as a showroom would be, but there'd be more area dedicated to sales than warehouse. Is that not correct?
It could be. It's a wide range of our tenant class C2, is what it based off of net rents reported to the city by owners. So what exactly it is, I couldn't tell you.
Okay, thank you.
Thank you, Mr. Harden. Mr. Tyrion, do you have any questions?
Yes, I'm interested in the mezzanine. You've indicated 5,869, I believe, out of the 26,430. Could you show me in the pictures on page 10? I'd like to understand what is the mezzanine here, if you could.
For sure. From my understanding, you can see if you turn to my page 10, you can see like the office space and the break room at the bottom there.
Yeah.
That would be part mezzanine. So like some of the office space and rooms like that internally are upstairs in that second floor. Some of the offices, maybe a boardroom, stuff like that is what's usually on the mezzanine floor of these dealerships.
That storage place just above there, is that up there or it's?
I believe that's main floor. I believe that's part of like the service garage and where they get parts for cars and stuff. So they keep it close to
the ceilings on the mezzanine are pretty high, I see.
And that's
they're standard.
Yeah.
Because the doors, if you look at the doors,
Yeah.
Okay, because I was trying to see, you've applied the rate to everything, so I was trying to see the distinction here. And do you know on your comparables if there were any, I know it was retail, a little complicated here, but any mezzanines in any of those, do you know?
Yeah, I don't know if they're including, like, if it's a retail, I have no idea which ones have mezzanine or not from the net rents reported in.
So it's pretty hard to use those comparables, I guess, to some extent.
Yeah, it's just, again, dealerships don't have these net rents. So I'm bringing in what we consider the closest comparable building, which is larger retail space.
Okay, the land area is 99,800 versus 20, so it's a pretty large area because it's a car dealership, obviously.
Yeah.
So the access is easy enough. It's off Almy, is it?
Yes.
Okay. Okay, that's all I had. Thank you.
Thank you.
I just have a quick question about your comparables on page 5, it is. Are any of these car dealerships?
No, there are none. There are no just pure net rents for dealerships.
So it's just straight retail?
Yeah, I've used the similar list for other brand new dealerships around the city.
Okay. Have you looked at other car dealerships?
Like been to them?
No, in terms of their net rates.
They don't have them. They're owner occupied. If they were net rents for new dealerships, I'd have a list of them for you.
Okay, so this is owner occupied, right?
Yeah, they all, from my understanding, all of the majority of dealerships in the auto malls and around the city are owner occupied by the dealerships.
So in terms of though there is this mix between a showroom and a service area. And as you said, these are larger retail. Is there any other types of properties that could be showroom versus service area that could be brought in? Or are they all under that retail
Well, they're just, again, like just the larger retail buildings are, in my opinion, the closest. You go in, they have the high ceilings. They have, a showroom for, let's say, couches. You use a Michaels or something, or not a Michaels, but, you use a Brick or something like that. You have offices in the back, or in a, some of these buildings have an upstairs mezz. Like, I know it's not perfectly comparable, but in my eyes, the larger space is as close as you're going to get if you're using other properties to compare net rents.
Okay. All right, that's my question. Mr. Neufeld, you can proceed.
Thank you. And just for a minor point of clarification, you've referred us to the pictures on page 9 and 10. If an inspection wasn't done, I'm just wondering, what was the source of these pictures?
The source of these pictures were, some of them were sent in when the new construction was done, and some of them were found online.
Okay, thanks.
Yeah.
Okay, so I'm just going to start here, and I certainly wasn't trying to make any strange points on the sale, but
sorry, can I bring up one thing? Sorry, before you start, I forgot to bring this up at the start, but same thing with my. I actually, it's just on page 4. The bottom of page 4 has auto dealer rates applied at the board of revision. So from my understanding, these are just a list of assessments that have been brought in and used as comparables. And I believe one of the earlier things you said in the starting of this meeting is we do not compare assessments. So I was just hoping this could be expunged or whatever unless I'm reading this wrong.
Thank you.
From my understanding, these are different 2020, or I don't even know what year, but they're just different dealership decisions.
and the board of course is free to put whatever weight they wish on it, and I respect your comment. So I will carry on.
So are we going to remove it, or that's before we carry on? Like, what's the decision here?
What's the page?
Page 4, bottom of page 4.
Okay.
And I would have brought it up at the start. I just forgot. Sorry.
In my opening remarks, I indicated that we will not be considering comparisons and assessments, and so we will not be.
Okay, thank you.
Mr. Neufeld?
Okay, sorry, and there is some strange feedback happening. I think it might be from perhaps people who have not muted, and I'm getting this really bad popping sound. I hope it's not me, but it's sometimes a bit hard to hear. Our workup, and on page 1, as you can see, we're using a rent of 1077, and I'll just follow this through in order of the document. It does not quite linear. Firstly, at the bottom left on page 1 is our calculation of a shortfall rate, and the shortfall rate does have to bear some resemblance to actual costs. And what we have done is looked at the tax, and we have it at 453. Now, it's actually in 2020 would have been 491, but we did adjust it downwards for the difference, a minor difference of about 10% for 2018. So that's what the tax load would be. Major component in shortfall to pay the taxes when you're vacant. Utilities, we're using 219, which is the city's number from the 2018 the business taxes, which are a fair estimation of most costs. The total load would have been 245, but portions of the building are not air conditioned. So that would be the approximate utility load for shortfall. And repair and management is somewhat of a common number for $1 for all sorts of management issues. Periods of shortfall, the argument is, well, you don't spend as much on utilities, but the opposite side of that is you spend a lot more on security and insurance for a vacant site. So we come up with 772. And the reason it's so much different is because this is a bit of a hybrid model in the modeling department at the city. And you can't pick and choose your parameters. They should bear some resemblance to what the Moving to page 2, the top of page 2 shows the location. And this is just off Lajemodier, and Alme at this point is a stub street. It does not go through all the way. It was, you can see that it ends at that point. This was not the original location. There was a deal made to bring it closer to Regent on a new development in the works. What happened is that development was not approved by the city of Winnipeg in a timely manner, and the deal couldn't go through. And the business had an expiring termination lease at their former site at 1066 Nairn. They had to move out at a certain time. So this was the only piece of land they could get in the vicinity that was development ready. This location is not optimal for what they would like. They would prefer to be closer to Regent, and you can see that they do back away from there. One could say, well, they got great visibility, but the issue is it's great visibility on a higher speed transit way that's meant for people are just going through. It's not a destination-oriented site. This is a transitory zone. So the preference would have been on Regent with the other auto dealers. So it is a location negative. In regard to the rates, moving to page 5, this is a copy of the permit. And you'll note that the occupancy class EF 2322, et cetera, below on page 5 are excerpts from the National Building Code. And essentially, page 6, this is a medium hazard industrial occupancy. Medium hazard means that it's not dry warehouse with boxes. It means that there are some materials in there of a medium hazard, and what that really means is oils and lubricants, because it is a car dealership. So this is how the building was built, but it was built to this standard, which means the type of construction was built to this standard. It refers to occupant load as well. There's a difference in occupant load and the standards require air handling, all of these issues. Car dealerships are not busy places where there's a ton of retail users in it at any given time. As a matter of fact, think in the COVID time, you can't go into a grocery store because there's a limitation on how many they can accommodate. That's never been the case in an auto dealership because they've never had a high load problem. It is designed and built as a low load for human occupancy. And the other parts of it are in the service area, for example, there's no air conditioning and great heat movement. There's exhaust systems and makeup air. Because that's the business, the work that they do. So it is an industrial building. For our rental comparisons, the assessor is somewhat right. There are a few rents out there, then they're very hard to decipher. What we were looking at were upper grade industrial users who have a type of retail use to them. And on page 3, we have a number of them. Down the street at 851 Lajemodier, that is a kitchen showroom with a work area in the back, $6. 1455 Buffalo is a showroom for a flooring company at $7. And it's showroom and storage. 1100 Waverly is a retail operation, which is I have to read my notes here, I believe it's a recreational facility, laser tag, retail, big empty spaces, $665. 1042 Waverly, along with 1036 Waverly further below and 1040 Waverly are in the same building. This is an industrial building that was converted for usage. One unit is the floor show, which is their showroom. The second is Super Light, which is a showroom and a warehouse. These are all low occupancy retail uses with storage in the back. And you see what the rent range is. The highest is an $11.50 rent, and the lowest in that building is at $7.25. And that one, incidentally, 1036 is predominantly an industrial use, but it's the same building. In my opinion, I mean, I've been through this building. The Super Light and the Floor Show are probably the best examples of this style of usage where there's an actual rent. There are some of these others which are in older and repurposed buildings with lower ceilings. Moving along to the next page, page 4, are some automotive related rents. And generally there's no shortage of auto body rents, and auto body is about as close as we can approximate to car repairs. And these are listed, and as I mentioned, there are some out there. Now, the first one, Maine, I wouldn't put much weight on at all. It's not in the same type. The second one is some reasonable weight on. This was a former motorcycle dealership repurposed to a used car outlet, $7 a square foot. Superior construction. The next is 3570 Portage, which is actually a converted consumers distributing to a mostly office use with a small detail shop. 3680 Portage is probably the only pure auto rent you're going to see in Winnipeg, $11.32 a square foot for a smaller building. This one became, as car dealers changed their model of what they need, the size of it wasn't any longer suitable to the original design, which was, I believe, a Mazda dealership. And then it became a used car at $11.32. 2554 Portage was the lease entered into originally by Mercedes, and when they moved, the sale was subleased to Birchwood Auto Group at $7.56 a square foot. Good finish on the building. The drawback on that site is that there's only about 50,000 square feet of land. So it's more suited to a specialty type of user. And it was fine for Mercedes until they expanded their product line and had to bring in the trucks. When that happened, it was no longer a good site. 3636 Portage is fairly old, long expired. In 2009, it was leased at $9.16. 1700 983 Wall, wouldn't, no weight on that. 1700 Waverly is an older sale, and I've seen it reported 2 different numbers. This is the one we assume was for the fee simple usage. 2150 McPhillips was originally reported by the city of Winnipeg. It was a short 3-year term for a Nissan dealership while they were waiting for the new premises to be built, an older sale. 1370 Dugald is in the neighborhood. It's 20,000 feet. The building is inferior. The location is inferior, but the land is superior. This is a rent that I was the arbitrator on, and 2 sides put their numbers together, and this is the number that was agreed to, $809. 1301 Dugald was supplied by the city of Winnipeg as an RV trailer. 2535 Inkster, arm's length market. This was, the information is out of date. It was extended, new lease drawn up August 2016, same rate. 700 Maury, another body shop, $6. And the Pembina ones are small shops, no weight. And then the last 3 are Boyd rents for auto bodies. There are a number of Boyd outlets. These were the 3 that represent arm's length transactions. They have several others that have related parties, and they range between $815 and $905. The building code is shown. The pictures, I did take a few pictures in the site and had the manager send me a few pictures of the site. And you can see it's clearly an industrial building with a build out. On page 7, a point to consider is the showroom. The showroom is an industrial building, and all that's been changed from a normal industrial building would be those tiles on the floor. There's not much else in an auto dealership these days that is a top quality finish. Sorry, we had some vacancy information here. This page 9 is from the Johnson report. In 2017, the overall vacancy in industrial, and this is the investment vacancy. So these vacancies are reported erroneously by many parties. I suppose it really matters what you're out to impress people on. The point. Johnson actually has 2 numbers. One is an investment inventory, and the other includes all inventory, including owner-occupied sites. An owner-occupied vacancy has nothing to do with the market. It's a business decision. The investment one is the owner wishes to rent property and puts it on the market, actively tries to market it. It's the one that counts. The overall rate, 7.2%. The Transcona rate, 22.8%. And we've just relied on the overall rate at 7.2 because basically the Transcona sample size is rather low and less accurate than the overall site. Page 10 shows the zoning. Page 11, 12, 13 are the parking. And under this basis, the parking requirement would be, sorry, I want to give you the right number here. Parking category 20, which is auto, light, truck, motorcycle repair and service, sales and rentals. That's 1 stall for every 250 square feet of floor area, over 2,000 square feet. And the numbers on retail vary. Now the standard retail is, is in the same usage, number 20, but except for the ones listed separately. So for example, a shopping center is 24. Now 1580 Regent is a shopping center. It has a different standard. And you'll note that it starts with the same number, 1 per 250, but then the city planning document has 2 more requirements on parking. And office, 1 per 750, which is better. But the restaurant, section 22, which 1580 Regent has, I believe, 4 different food service operations. Their requirement is 1 stall per 100 square feet, or if there's a drive-through, 1 per 150. What this means is that there's a greater parking load required on a power center, shopping center than there is on a car dealer. And as a result, they need more land to fulfill that need, and that land must be paid for through rent. And that's one of the reasons we're rather hesitant on using the retail, is because the uses aren't the same. Now, I've heard this many times. People will say, well, you have all those cars parked in your lot. You got lots of parking. Those aren't cars. That's inventory. Car stalls are for the clients. Now, the industrial is closer. It's 1 stall per 1,000 square feet of area. And that's really what they end up using in their usage. Zoning is on the following pages. Then there's a couple of comments about capitalization and then some information on cap rates that gets reported. I note that the assessor did not refer to Colliers. Oh, I'm sorry, they did refer to Colliers in their study. I don't know what weight they're putting on it, but there is an explanation of how Colliers devises their rates. And incidentally, this evidence on how Colliers does the rates has been entered at the municipal board as evidence. So there is further testimony on it at the board, and the assessor would be aware of it. Page 31 is just some narrative on the application of cap rates, and this is taken from our general records at Colliers. What we talk about is on page 32, is how do you cap an auto dealer? And on our standards, investment grade, very low. And the reason being, it's a purpose-built structure. So when auto sales are hot, they're in demand. When there's a problem, it's very low, or there's a change in the way autos are being marketed. And as of today, we are in the middle of another change. We're moving to the online method. Market supply and demand. Supply is below average and demand is above average, because now what you're seeing in our market is people trying to redevelop to meet a different model of car marketing, and they're having to build their own. And when that happens, their costs drive up, but they're reacting to the business. Now, it doesn't mean it's a good investment. It means when you get rid of it, there's going to be a below average demand for it, which drives the cap rate down. The reliance on your financial information, of course, is very poor being owner occupied. The rates and comments, there are no real rates. We have seen a few that you could call hypothetically comparable. In the real world, the capping is higher to reflect the low lifespan of these properties. And as an example, all one has to think about is look around your community at the different auto dealers that are now vacant and converted to a different use. They do have a shorter lifespan. Polo Park is going to celebrate its 62nd anniversary next month. Auto dealers like 750 Pembina get torn down, abandoned after 20 years. That's just the nature of this. And the concept on a cap rate is you have to meet the investment life of the property, and you have to recoup your investment over that estimated lifespan. So that drives up the rates. It's not a standard investment. The application of a cap rate is, as a result, is, as I say, more hypothetical. And the concept of direct capitalization for a car dealership is simple. And that's its only advantage. It's not good, it's not accurate, it's just simple. And no disrespect to anybody, but it makes it easier to debate if you're just talking about simple direct capitalization. The truth of the matter is that they likely have to be done on a model resembling a mortgage equity concept, which is take the life of the property, hypothetical mortgage on it, a rate of return for an investor over the same period, and work out a cap rate. It's harder work, but it would be more accurate to explain a property that has a different lifespan and than another property. The last point is the concept of non-recoverables. And I know I did not ask the assessor any questions on this, and he has put some information in, and I'm at the back, a fresh look. And the last few pages, we have our calculations of some Colliers managed properties on sample non-recoverables. The issue is that non-recoverables exist. They can't be erased with the stroke of a pen and say, we don't have any information, therefore they must not exist. They are a constant theory and a requirement to deal with because every property has non-recoverables. At the high end are investment properties. who have separate asset management whose costs directly relate to the market value because you're required a secondary level of management. They typically run about 3%. At the low end are the small investor whose time that he takes to bring the check to the bank, to talk to his accountant and pay the accountant's bill, and to deal with the matters over and above the normal property management are asset management. They are costs. Nobody does work for free. It is a standard allowance. It takes into account the variances over the years. For example, commissions, TI costs that only may happen every 10 years. They get stabilized into a 1-year number. The actual number in our analysis is that non-recoverables are likely closer to about 7%. And the reason for that swing is generally the vacancy that occurs. And on a more stabilized basis, we've always accepted 5% as appropriate, standardized, something that every investor will take into account. Because at the time of sale for an investment, they're looking forward and you're predicting how much do I have to deduct for my non-recoverables. It isn't, did I have a good year last year? Maybe there weren't any. Next year will also be good. No, it's always forward looking. And even if hypothetically you say that it could be post-reference, imagine the sale that occurs April 1st, 2018, and an investor decides what I'm going to apply for my expenses, and a 5% or something similar for non-recoverables will be applied. Taking this all back to page 1, we end up with our final number. Now, I'm not supposed to talk about 1077. The rates we've used support 1077. In and around that number, $10.50, $11. The exact number was chosen because it's the same number put on Mercedes by the board. Mercedes is the same ownership. It's the same building. It's the same construction. It's the same concept. It's the same idea. There's a mezzanine. There's a service shop, and there's a showroom built to the same standards. We're not arguing equity. I'm just telling you how our decision-making process was established. After that come the vacancy is 7.2%. Now, incidentally, we have shifted from the assessor's 2% number that they applied because I feel that that's lacking clarity to simply say we're allowing expenses. That is an additional expense that for the last few decades has been applied for structural reserve, which is another requirement. So we are now expressing that in a different manner, sometimes percentage, sometimes an amount per square foot based on the type of building. And in this type of building, industrial building, 25 cents for structural reserve is fairly standard number. So this isn't just, we're not looking for an argument here. We just want some clarity. There are two sets of non-recoverables. There's the structural reserve, and then there's costs you can't get from your tenants relating to that don't relate to the daily operating costs. The cap rate selected at 8%, which is based on page 35 and forward, standard rates that we should be looking at, with a fair amount of weight focused on page 29, which is the old-fashioned way, which is mortgage equity. 70% loan ratio, 4.5% interest. Investor requires some return on his equity, and thank you. And that is my report.
Thank you, Mr. Neufeld. Mr. Spacek, do you have any questions?
Oh, I still have coffee.
There we go. Thank you. Yeah, just a couple of questions quick, if you don't mind. Load this here. So I'm just curious, You're saying this is an industrial property or an industrial building. What is the zoning of this property?
C2,
Commercial. Okay.
which has nothing to do with the building. It's the zoning.
Yeah, which really kind of sets the baseline for what could be built there, correct? And what it could be used for.
It has nothing to do with the construction of the building. It's a usage issue. These are two separate factors. Just be clear. I'm not trying to be argumentative. I apologize. It's just there are two factors.
Yes, and then when, just for my understanding then, or the board's understanding, when this building is built and it's approved, the permits are approved, it's built, that you are then the last step after all the inspections are done, you're required to get an occupancy permit. And you're saying this permit is making it an industrial building? Is that what my understanding is?
No. Permit doesn't make it anything. It's a final reporting.
Yes.
But the process of a permit starts. An occupancy permit starts when the first permits are taken out, right in the beginning, where the architect submits his plans. This is the building I want to build. This is the use that it's for. This is the National Building Code standard I'm building it under. Then the city comes along and reads it all and says, "Okay, you are a EF, whatever it is here,
F1, F2."
Right, but this is something that the architect originally applied for on the original permit, and then the city issues the permit based on the occupancy class. I guess the issue here is if we have a lot of differences in building type, and when a retail building won't have the same occupancy class, and it's just the debate has always been, what is an auto dealership? Is it industrial? Is it retail? Is it a hybrid? Technically, it's industrial.
And okay, and just to continue my question here, when the occupancy building classification is created, right, dealerships are required for that. F1, F2 is just, from my understanding, spray painting operations for F1, and it gets the F2 because it has a repair garage, service station, and sales room. So all dealerships would have that F1, F2 classification, correct?
No, there's no spray painting in there. My understanding is that if, and I haven't checked into this in detail, but that if you're actually doing higher hazard, which might include spraying, that there's a different number group on page 6. You can see that there's low hazard, and then there's medium hazard, and then there's different standards for different ones. And this is just a very, very short excerpt from a 1,500-page document, so it's going to vary. I would suspect body shop represents a higher hazard, but likely because of the airborne vapors, which don't happen in a garage. And by the way, the low hazard versus medium hazard is just the oils. That's like a low hazard is going to be a warehouse full of boxes that you move with a forklift. Beds. But I think medium hazard would represent like a refrigerator, because there's a refrigerant in there.
So you're agreeing with me?
I don't even think we're talking about the same thing.
Yeah, I'm just, my question is simply, when to become occupancy building classification of a dealership, like these dealerships are required as per the commercial alteration design summary guide. So that's where you go through to get the requirements for what your building classification is going to be on these occupancy permits. F1 is spray painting operations. It has that. It got F1. It has a repair garage, service station, and sales room. That's F2. That's as deep as the guidelines go for F1, F2 from what I looked up. So I'm just, do you agree with that, or am I making that up?
It doesn't have an F1. It has an EF2.
Okay, so exactly. This one doesn't have spray painting. But when I looked and I compared it to other dealerships, anyone's with spray painting had F1. Anyone's with the repair garage had F2. So let's say we go forward 20 years now, we're changing uses. Like you say, it happens to a lot of dealerships. Maybe it turns into a retail. Maybe it turns into something else. There's going to be an occupancy permit needs to be filled out for for the new tenant going in, correct? And they would, if they got rid of the repair garage, service station, sales room, you wouldn't have F2 on that occupancy. That's all. That's my only point, is just this is going to change based on the tenant. Right now it's a dealership. I think we're putting a lot more weight on this occupancy permit that needs to be for the valuation of it, is all I'm saying.
Well, I would disagree with the concept that you're worried about the usage. What I'm saying is, this is what it is. This is how it was built. Now, if you want to change the use and you put capital in it, you change the use, you will change the value, you will change the permit. I don't think we can speculate on that. I'm just saying it was built this way. This is and this is what we should be doing at this point in time, is comparing it to other buildings built in this way. Unless you want to spend $2-3 million in capital to upgrade it for greater human occupancy loads.
Thank you. And so for your comparables, industrial rental rates, for example, 851 Lash, 1455 Buffalo, 1100 Waverly, are these all zoned commercial as well?
No, they're a mix of zonings. Most of them are M2 zonings. Let me just take a quick look at it. I believe Lash is M2, Buffalo M2, Waverly is a mix of M1 and M2 at this point. What were your other ones? I'm just going.
I just said the first four you used. I'm just curious.
Yeah,
they're all industrial properties.
Well, generally M2, and M2 is where most car dealers are now in. So the C2, it doesn't really disadvantage them. It's for their usage. The zoning. Well, what happens in C2? The difference being that on page 10 we put in the dimensional standards for industrial versus commercial, and the big problem on the C2s is you'll note at the notes at the bottom and the setbacks on each of them that they differ. So if essentially it's if you're close to a residential zone, there's going to be different setbacks requirements on the initial, and then on page I'm just looking for automobiles in the zoning, bottom of page 16. You'll note that the principal use table it allows anywhere from C2 to M2, and there's an asterisk beside each of them, which means that there are separate standards. And in this whole document, it's a few hundred pages. What they're going to refer to are lighting issues, setback issues, and that sort of thing. So what I did in my analysis, a direct answer to your question, is I relied on sites where I knew that none of these factors were of a concern. The rents I provided I believe almost all these buildings I have been in and personally inspected. So we know that there are no zoning issues which will confuse the matter. Thank you.
Just one more on these rental comparables, but for example, your first four you spoke to there, do you have the effective ages of these or the years built? Are any of them close to a newer build in 2020, age-wise?
Just a sec. So which page are we first looking
We're
at?
still on page 3.
Okay.
I don't see any year built. I was just curious if any of them are newer properties like our subject.
I'll just quickly whip through them with the approximate ages. Lajmodi is early 80s, I believe. Buffalo was 66. Waverly was 78. Waverly 2 is about 74. St. James is early 60s. Fennel is brand new. Skipping down, Irene was mid 70s. Wilkes is 2011 or 12. Clarence, I don't remember that one. And Lawson is 90s. And I can go through them all, but yes, we have a variety of ages in these properties. And not a factor, as I mentioned, I inspected, I've been in all these. What I was looking for is utility and good remaining economic life.
Okay, thank you. And you spoke on page 7, your pictures. I recall you saying, if you look at the showroom, you're saying it's an industrial building. What's the difference between this being an industrial or a retail for this room being a retail showroom?
Well, there's different occupancy loads, people loads on this. Now you have the cars parked in there. So you're now dealing with a different occupancy standard. You're set up for a low people load. So your air handling equipment on a showroom are focused more on the carbon monoxide part of it. So your air handling equipment will be dealing with ejection of the low air and replacing with upper air, because carbon monoxide goes lower to the ground. Whereas in a retail facility, you're going to be focused on hitting a comfort level of a temperature load and a humidity load. A humidity load is generally far more important. Depending on what you're selling in your store, you can't have overly dry or overly wet air. For example, in a grocery store, you need some standardization, and we're not emitting vapor, so that's not an issue. So the air handling equipment will differ, and then there's the level of other infrastructure with a very, very large, broad floor. The electrical distribution is focused on the outside, and then that's permitted. So that'll vary on your usage. If you have retail with demising walls and separate areas, you're going to have separate electrical load requirements in each of them, lighting requirements. The lighting in here, as an example, is based on the showroom lighting, and you'll notice the page at the bottom of there, this is an office standard lighting load, which differs. So all of these things go into the original costs, and basically shell cost for an auto dealership is the same, identical as shell cost for an industrial building. And shell cost for a retail building will be in the neighborhood of about 40% higher. And code, which we don't see, is mostly the reasons.
All right, thank you. That is all my questions.
Thank you, Mr. Skachik. Mr. Hardy, do you have any questions?
No questions that haven't been asked.
Thank you. Mr. Kirian, do you have any questions?
I just have 2 points. You mentioned not an optical location, but I see the Steinbach Credit Union is pretty close to it, and I'm not sure what's on the right, but how do you argue it's not an optical location? Because it's a great visibility area. You mentioned that yourself.
Well, what I did say was visibility was great because there's a lot of traffic going by, but it's not traffic that can stop conveniently nor cross from the other side of the street. Regent is a different altogether. If you're located on the north side of Regent and you happen to be going eastbound, there is a convenient turn lane with a signalized light positioned every half block. And that's why retail wants to locate on there. The speed limit is lower, and it's a street that's destination oriented, allowing both destination purchases and impulse purchases. The location on Alme does not have that. It is more like a highway style location. If you want to go there, you must likely have planned to go there. There's no alternate exits out the other side. There's just the one entranceway. It was a secondary choice, not even a secondary choice. It was a choice of last resort due to an expiry elsewhere. It works. It can be adaptable and meet an average standard for an auto dealership, but on an alternate use, it would never meet any standards.
Okay, that's fine.
I can't.
My question.
Cannot comment on Steinbach Credit Union's decision, which was part of your question.
Well, I just said it's located there, and I thought that was quite visible. That's all. That's all, Madam Chair.
Well, in response, again, the other building located nearby is the taxation center. And they don't mind that location either, and they're a different animal.
Thank you very much. That concludes our hearing on 1555 La Genaudière. Pardon me. Short. We need another 2-minute break.
Okay, that was great. I was going to ask for one. Thank you.
All right. Thank you, everybody. See you guys later. See you all later.
I'd like to call this meeting back to order. Next on our agenda is 130 Lawson Crescent, and before we start, we'll ask Michelle to swear in the assessor, please.
Can you state your full name, please?
Stephen Lobenstein.
Do you affirm that the evidence you're about to give at this hearing should be the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Welcome, Mr. Lobenstein.
Or good afternoon.
Good afternoon. Okay, all right, we can begin with 130 Lawson Crescent.
Okay, 130 Lawson Crescent. The roll number is 100140500, and the assessed value is $8,564,000. So just to get started, this is a supplementary appeal due to a renovation on the property. It's a little more complex than just a renovation. There is actually a renovation to an existing building. And on top of that, there's actually a new building that was built on the property as well. So there's sort of two different improvements that have happened to this property. So I'm going to quickly go through and just show where the building's located and the improvements and everything that's been done. We also, Mr. Neufeld and I did an inspection of the property on March 30th. So we have some pictures in the brief as well. So I'd like to just go through the brief first, explain what's happened to the property and how it's changed, and then I'll get into the actual valuation part of it. So moving to my page, just moving to my page 12 in the addenda, you can see the location of the property. It's 130 Lawson Crescent. It's just off Kenniston, near IKEA. Lawson Crescent's basically like a little bay where you can enter off Rothwell and Lawson, and that's where you exit. Although a lot of these buildings you can see on page 13 front Kenniston, they don't have access to Kenniston from their frontage. They have to go through Lawson Crescent. Further down my page 13, you can see what the site looked like before the renovations. So you can see the building that fronts Lawson there. There's no access, fronts Kenniston. There's no access to Kenniston. And then you can see behind the building, the vacant part of it where the additions were put. So going down to my page 14, you can see a somewhat crude drawing of what the new additions now look like. In the map, you can see there's one addition to the improvement. And there's another new building off of the existing building that fronts Lawson. Again, there's just a few more pictures of what the property used to look like on page 15. And so I'm going to move down to just give me a second here. So I'm going to move all the way down actually to page 63, the last page of my brief, just to give you some exterior photos of the building. So on page 63, this is the new build. This is the front of the building. This is a warehouse with office space. 62, we're going to work our way up the brief here. Page 62 shows another exterior photo of the bottom of 62 shows an exterior photo of the back of the new building. And then the top of it, this is the addition to the existing building. So this is a new addition on the top of page 62. And on 61, you can see that's also the new addition. And on page 60, you can see the back of the new build as well. So those are just some exterior photos of the property. Sorry, I'm jumping around here a lot. It's not the best way to do this, but there's a lot to cover. So we'll start with some more pictures on page 39 now. So when you're on page 39, this is the interior of one of the premises of the new building. As you can see, it hasn't been built out yet. There's still floor to put in. It's pretty bare, but it's an industrial property with high ceiling height, as you can see, and one overhead door at the back. There's just a few more angles of this on page 40. So, and then on page 41, you can see there is a maintenance room or a utility room as well. Now, also on the bottom of page 40, this is next door to that vacant space. This is now tenanted. This is what the office looks like. It's been built out. There's just more office working. This is the main floor office on page 42. There were people working in there at the time, so I couldn't get full pictures of all the offices, but it gets you an idea of how it's built up. And then there's also the warehouse portion, which is pretty identical to the other side, other than they have a floor. They asked me not to take pictures in the warehouse because they had merchandise in there, so I couldn't really take pictures of what their warehouse looks like. But you can get an idea from the pictures I showed you before. It's high ceiling height, wide open. It's actually fairly bright. They have quite a bit of natural light coming in, which is pretty unusual for industrial properties. And then there's also a second floor to this property as well. So you can see they have a boardroom on the second floor on page 43. This is the stairwell to get up to the second floor. It actually has its own exit and entrance as well. And just another picture of the overhead door on page 44. So now these pictures here are the new addition. This is added on to the existing property. So this is also being rented out. So you can see just a maintenance part of it, the furnace and the hot water tank on page 44. There's offices as well. On page 45. On page 45. Page 46 shows you an upstairs part. There is an upstairs part that hasn't really been built out. Looks like they're just using the storage right now. And interesting enough, on the picture on the bottom of page 46, there's a door that opens up to the warehouse. So this gives you a good view of what the warehouse looks like. And page 47 gives you an idea as well as what this warehouse looks like. So this is the new addition to the already existing building. Now the pictures here of the existing building. There's a brewery in this building. So when you first enter, you can see the high windows on the top for the office space. They have a counter here, or a front desk reception area, of course. And as you work your way through, you can see some pictures of some of the vats they have for brewing. And there's also mezzanine space where they have offices on page 49. So you get an idea of looking down onto the reception area from the mezzanine area. They also have a boardroom in the mezzanine area and some offices on page 15. Taking you through into basically the warehouse portion where they brew the beers on page 51 and 52. I'll quickly go through here. This is the existing building. Page 53, you can see all the vats they have in here. You can see the ceiling and the floors. And same at 54, you can see the operation they have going on there, the machinery they have in there, the storage they have in there. If you look at the back on the picture of the bottom of page 54, you can see an overhead door. That would be to the new addition, the new warehouse addition, where they store a lot of their product. On page 55, you can see the overhead doors they have for moving product in and out. And then we're just moving through to 56. There's a lot more machinery, of course. 57, the bottom of 57 is a cooler they have in there. They have an industrial sized cooler for the beer, obviously. And 58 shows where where basically the unused hops and barley are put into a truck in a garage and moved out. There's also drainage in there as well. So, and then at 59, this is the only picture actually I have of the new addition. So this is part of the new addition for the brewery where they're storing all of their product. So this gives you an idea what's happened to this property, how there's been an addition and a new building on it. I've included a bunch of the schematics and plans. I won't go through them. They're for your reference if you want to look at them. They start on page 33 for the new construction part. Actually, page 33, the top of it gives you a good layout of what the property looks like now. It's also on page 34, 35, and then there's also the new addition plans. Page 37 gives you a good indication of the wall height and the size of the new addition to the existing building. So that's for your reference to look at. So that being said, I'll start with the valuation part of it now. So back to page 1, we have the property description. So we consider this an industrial light manufacturing. We have 6 premises now. There's 2 stories in some of the buildings, as we've shown with the office space in the mezzanine area. The actual years built range from 1999 to 2020 for the new build. So we have an effective year of 2010 on it. The wall heights again range depending on the structure itself from 21 feet to 28 feet, and the zoning is M3 heavy manufacturing. The plan area is 50,060 square feet, but the actual leasable area due to the second floors is 56,264 square feet. So moving on to page 2, we can see some subject sales history. So the subjects sold in January of 2016 and then again in January of 2017. In January 2017, it sold for $4.5 million. On pages 17 and 19, I believe it is, I have, on page 16 actually, you can see the 2 basically advertisements for the purchase or for the sale and for the purchase and the sale of the property by Vermont Property Group. And then on page 18, you can actually see the sales mailer for the sale for $4.5 million. And it's interesting to note on the sales mailer that did you intend to make any major repairs or improvements? They obviously clicked off yes. They put approximately a 2M, so I'm assuming they mean $2 million for the amount that they're putting into the renovations, approximately. So going back up to page 2, there are subject leases for this property. I'll get into that a little bit later. They have income expense mailers. So for rent comparables, we use rent comparables for our model rents to develop our model. So to show that our model is accurate, I've brought up quite a few rent comparables here. There are different lease sizes. They're close in wall heights. They have different effective year builds ranging from 1989 all the way up to 2016. And their lease starts also range from 2011 to 2017. And their lease areas are similar to the premises. So the net rents are interesting because they're all located in just the southwest area of the city where the subject property is located. Being either directly across from Kenaston in the on like Commerce Drive, that would be the Terracon Park, or they're in with the Wilkes area or the Scurfield area, so they're actually in fairly close location to the subject property. So moving to my page 4, you can see the premises now. So initially, the premises would have been premise 24245 and 33888. Those were the original building, and all the new premises are the ones below it. So we get a total leasable area of 56,264 square feet. We get a potential rent of $556,711. So then we're applying a 2.5 vacancy percent, our 2% expense ratio, which we've gone over numerous times this past year. And we're applying a 6.3 capitalization rate to come out to a value of $8,564,000. So moving down to my page 6, you can see our capitalization reports. We actually have this on the lower end of our 20th to 80th percentile at 6.34. I believe that the model came up with this because of the age of the building. So with an effective date of 2010 now, we take the location into account, the square footage. So at 6.34, I feel that's a fair capitalization rate for this property. On page 8, we have our fresh looks. We've gone over this before. We have our capitalization rate evidence at the bottom for industrial on page 9. And we also have our non-recoverable expense sampling on page 10. So I said I was going to speak a little bit about the mailers themselves. So on page 20, I have the 2014 mailer. So I've included the 2014 mailer, the 2015 mailer, and the 2017 mailer. The 2016 mailer was never sent in to us. On page 20, there's a rent roll. It's a little hard to see, unfortunately, but I can tell you that on the highlighted areas on the bottom of page 20, it is a step-up lease that they have for the brewery, and they have it starting in 2016 and going to 2019 for a base rent of $10. They have the same thing on page 21. That would be a $10 rent they're showing at the bottom of page 21. And then, right, page 21 and 22. And then they also have the 17 mailer on page 23. Again, this mailer isn't filled out as accurately, but it also is showing a $10 rent per square foot for this property. I have a few industrial reports on page 25 and 26 just to give market evidence. And for your reference when you need to see it, also on page 27. So I feel, and one other thing, I have the construction permits as well. So you can see the construction permits on page 29, and on the lower right-hand side, you can see the declared construction values for your reference as well. I should point out that one of the permits as well is for a sign. They have a digital billboard that they have on the property that they generated income for. And on the 2017 mailer, they said they generated an annual income of $13,125 from the digital billboard. And one last thing to mention here, on page 38, I have the land titles that shows the mortgage for $4.5 million when the purchase of the property in 2018. And it also should be pointed out, I say this for last, is that there is a right-of-way easement on the property. And as you've seen, I should have pointed this out in the pictures, but it escaped me at the time. If you look on page 13, at the bottom, you can see a road that connects to the adjacent property. So there is a right-of-way easement for the adjacent property. Just something for your knowledge as well. So yeah, I feel I've covered just about everything in terms of the renovations and the inspection. I feel a value of $8,564,000 is fair and equitable and should be confirmed. Thank you.
Thank you, Mr. Wolfenstein. Mr. Neufeld, do you have any questions?
Yes, I do. Just want to figure out where to start here. On the building itself, is it fair to say that the two buildings have different styles or different types of properties?
Yeah, I would say that's somewhat a fair assessment. The standalone building, the new build, the front's Lawson, is probably a more modern style. At least the way they built it out. You have your office and your warehouse beside it, so you can kind of consider that a flex warehouse space. And then behind it, they have obviously the large 11,000 square foot addition to the, which is just your typical storage warehouse. And then in front of it, they have another premise where, although not as highly finished as the new building, it's another kind of typical flex warehouse.
Okay, yeah, no, that's pretty much what I was thinking, is that it's you got maybe light manufacturing, warehousing, and then flex. Okay, and now on page 4, just to clarify then, the brewery, is that the first 3?
Yeah, the brewery would be the, the brewery is not the first, the building is the 4th. So like the first 4, but the brewery would be premise, so 24245, 33888, and then skip the next one, and then that would be the warehouse at 295861.
Oh, okay, so the brewery is the 11,550. So the 5,000 square feet, that's the pool chemical place?
Correct.
Okay, all right, okay. So 1, 2, 4 are the brewery, 3 is the pool warehouse, and the last 2 are the other building, the 2 units in there, 1 occupied and 1 vacant.
Correct.
Which one's the vacant one?
The vacant one would be the 6,000 square foot.
6,000 vacant. Okay. So as to the pictures, and by the way, you never thanked me for taking you to a brewery. I was waiting for you to.
Yeah, well, I mean, you didn't buy me a beer, so.
But my son thanked me. It was all,
It was fun. I enjoyed that inspection, Rocky. Thank you.
And just to point out, in this day of COVID, we didn't see anybody on these trips except James, right? Well, in the 1 occupied unit, there were a few people, but the brewery was what, 2 people, 3 people in there?
Yeah, there weren't a lot of people in there working.
Okay. So moving to page 39, the picture. So this is the last premise ID ending in 764 then, correct?
Correct.
And so this is, the floor isn't finished?
Correct.
And it's waiting for installation of all the mechanical and finishing. Yep. So why would this be assessed? And I was then going to compare that to page 42, 43, for up to 45. Yes, that's the finished one.
Yeah.
Why would the rent that you apply be higher for an unfinished space than for a finished space? Aren't you supposed to assess it as is?
Correct. So unfortunately, because nobody got in there to do an inspection until I went in there, when we spoke with, I guess I'm not too sure who they spoke with at the time, but we were under the impression that this space was finished. I think there was a miscommunication at the time.
Are you suggesting that number could be changed?
I'm suggesting that number could be changed. This is obviously not renovated space. I'm not going to argue that. So when it was put in, the model predicted that it was basically similar to the space beside it. It was renovated. That's
all right.
Okay.
Yeah, no, and that's fine. And then the other pictures on page 46 is 47. This is the pool chemical storage place, yep, which is attached to the brewery.
It's attached to the brewery. Yep.
Okay, and then from 48 forward is the brewery space.
Yeah.
Okay. You had mentioned on page 16 to 19 about the sale. In regard to that purchase, are you familiar with the purchaser?
Aside from doing a guided tour with him, no, I'm not familiar with him.
Are you aware that he adjoins 2 properties in the immediate vicinity?
I'm not aware of that.
Are you aware that he has been active at trying to expand his fencing business operation for the past 10 years?
No, I don't know anything about his business.
Why I'm asking this is when you get these sales questionnaires, do you study the effects of assemblage?
I do not. No, I don't believe we do. We have to assess each property individually.
Okay. So other than the questionnaire, you have no other information on his motivation for...
I don't know his motivation on purchasing the property. Aside from the only motivation that we see is on 16, where if he intends to do renovations or make improvements, which he did.
Okay, so on that basis, intended to make reservations 2 million, purchased for, you say 4.5, that's 6.5 million he intended to spend.
Again, he's putting an estimate down there. If we want to see what he actually spent, we can look at the permits below.
The permits, but then you also have to look at the initial sale and determine the effects of assemblage, correct?
No, I don't know what his motivation is of assemblage, so I can't determine that.
What about the impact of the leasehold improvements? Did you see a copy of the original lease to Fort Garry Brewing?
Yeah, he sent me a copy.
Yes. The brewery lease. I believe I emailed that to you, correct?
No, I said, yeah, you sent me a copy, yeah.
And there are a fair amount of recoveries in the rent due to the initial construction. Is that not correct?
I believe so, yeah.
Okay. And that was a long-term lease with step-ups that were decided in the original year of construction?
I believe, I don't know about the originally, like 1999.
Yes, it was a 20-year lease with the step-ups provided for in the lease upon renewal, correct?
That part I didn't get to. I didn't see that.
Okay, all right, I'll leave it to my evidence. That's fine.
Yeah.
Now, because we have these 3 different types of occupancies on your page 4, were these different occupancies taken into account? I noticed that they're all called C2. Is that to say that they were all the same parameter was applied except for the mezzanine?
Correct.
Okay. And the mezzanine picture on page remember us both looking at that. On page 52, you show an elevated vat, and that mezzanine would be the space above there on the decking above it. Is that correct?
Page 52, yeah, there's an elevated vat, so you can get to that elevated space from the mezzanine, yes.
Yes, and that's what it is. It's a kind of a walkway that surrounds a vat, an elevated vat, that mezzanine space.
Yeah, I mean, it definitely borders it. Like you can get to the that area from the mezzanine space. Yes.
Yeah. But is page 52 the bottom of that mezzanine space?
Yeah.
Okay. And
well, only a portion of the bottom of the mezzanine.
Right. No, sure. And I appreciate that we did spend some time looking at that, and I'm just wondering if you had a chance to review whether or not that should be considered as rentable space.
We aren't considering the top portion as rentable space, but yeah, we are considering the bottom portion.
Right. Oh, so I just want to clarify, is this 2,400 square feet the office mezzanine, or is it the manufacturing mezzanine with a vat in it?
I don't believe it includes the vat. I think it just includes the office area.
Okay, that's why I was asking about the lease. I thought there was a breakdown in the lease we said here. On the rents you've provided as comparables, that would be page 3. Did you review these properties?
On page 3,
Have you been in these properties?
not particularly all these properties, but I've been in the 2 Scurfield properties. I've been in multiple ones in the Terracon Industrial Park.
Well, I'm just wondering about the Terracon. I happen to be looking at their rent roll while I'm speaking to you, but aren't all of these offices? Haven't they all been built out as an office?
Consider them like similar to the new build. We consider them flex warehouses.
But they, at this point in time, as they exist today, these are generally offices, are they not? Does Terracon have?
Offices in there, but there is components of industrial.
Okay, well, which one of these have an industrial component of the Terracon units?
Well, they all do in a sense because they all do have the overhead doors, and so.
But isn't that because Terracon builds from one set of blueprints for every single building they own, and that they end up being built out as office and rented as office?
Not just office. I've been in some where they are industrial type properties. I have some landscaping companies in there. This is the interesting thing about like flex. The warehouse is a flex. You can have office space, you can have industrial space. They do build it out. So, I mean, I feel like. Sorry, I was just gonna say. I feel like the new build was kind of built in that style. That seems to be really popular in that area.
Okay, and I don't necessarily disagree with you. I just want to, I'm not focused on the new build. I'm trying to look at the old section with the brewery and look at the Terracon rents and wonder, do they have any breweries in this?
And that's why I included some other rents in there, like 125 Fennel. And there's 1175 Wilkes.
Okay, what's in 125 Fennel?
125 is First General Services.
Okay, so First General Services, and have you been in that building?
I have not. No.
So they are you're not aware that is a predominantly an office building?
Again, how they build out an industrial building, I don't think is important. Like that's just the building itself, the actual framing and how it's constructed with the overhead doors, the higher ceiling heights. Again, they could pull that building out there and put in another type of property, and it would be more industrial. It's more the how it's constructed than what actual business is in there.
Okay, but have you seen the lease to determine if the landlord paid for the improvements to convert it to office and therefore based his rent on that?
I have not.
And sorry, 1175 Wilkes you mentioned?
Yeah.
And who's the user here?
We have it in as a trampoline park.
Right. And was this lease actually ever executed?
I do not know. That's a good question. I would, from the information that was sent in to us, I would think that it would be executed.
Okay. Do you know how much TI was amortized into the lease, the original lease?
I do not know.
Now, and you mentioned it's a trampoline, which is a recreational use?
Yeah, recreational use, yeah.
And other than what we do after we have a beer, beer is just a manufacturing site, isn't it?
Yeah.
So you're not aware that there were several $100,000 of TIs amortized into the lease on that original term?
I'm not aware of it, and whether or not that was taken into account for this figure that we have here, I'm not too sure.
Okay. I'm just wondering if were aware what the actual number was on this. I happen to be looking at a lease here, and I know that this is technically rebuttal, but your answer is you're not aware then, correct?
I don't have that information with me.
Okay. And sorry, what were your other industrial comparables?
Well, they're all there. We have 1290 Keniston as well, 62 and 35 Scurfield.
The Scurfield ones are offices, are they not?
Or the offices? They're office warehouse. They're the flex warehouse. So.
But you don't know if they've been built out as, they have been built out as office. You don't know where the money came to build them out as office, do you?
No, but the majority of the spaces is warehouse area with office build out in it, of course. And where that money comes from to build it out, I don't know if the tenant or the landlord built it.
Well, I gotta tell you, my house backs out onto that property. There's no industrial activity going on there. So I'm just wondering if it's fair to call them office. You haven't observed this industrial activity?
I have been through Scurfield many times. There are trucks that come in and out of these properties. There is industrial properties in the area.
Absolutely, but not those ones. Okay, sorry, that's argumentative. And the rent at 1290 Keniston, which unit is this?
That is the West Coast Kids unit.
West Coast Kids? I'm looking, I see 3 units there.
Yeah, it's the furthest unit. It's not the furniture place, not the brewery or the dry cleaners.
Okay, and so it's a retail operation.
Yes.
And there is a brewery restaurant in this building as well. Was it not available to as a rent?
I don't know. This is the one that, for its square footage, that I felt was a good comparable.
Okay.
And obviously, the lease start and the lease term.
Okay, sorry, I'm moving on here. On your evidence pages 20 to 23, these are the statements that were provided to you. Do these not indicate a relatively high degree of non-recoverable costs? I mean, from what I can read, 76,000. I can't read the next one really well. Looks to me like, I can't tell the number, a few thousand. There are high non-recoverable costs here, they're not?
They're probably a little higher than usual, yeah.
And the assessment department model has not allowed any non-recoverables, is that correct?
Well, our non-recoverable cost is the percentage of the expenses of 2%.
Expenses, the total expenses, which includes non-recoverables and any form of structural reserve, correct?
Just it's our expenses at 2%, yeah.
Expenses period, okay. The subject exceeds this, is that correct?
I actually haven't done the calculation, so good.
The cap rate you've used, your table page 6, where does this come from?
This is a model-driven cap rate.
Okay, but you've got 4 lines there. I take it they're all the same line, so all industrial fits into one?
Yeah, we have the industrial fitting between the whole industrial market fitting between 5.5 and 9.8.
And
this one fits within the majority, just barely at 6.34.
In your model, on page 6, you have 4 lines for industrial, but I take it in your model there is only 1 line for industrial?
Well, we take into account the different types of buildings.
Sure, but on
I mean, if you're talking about property type, yeah, we seem to only have one line.
Yeah. The reason you have 4 lines on page 6 is you're trying to compare it to what real estate companies break down, but your lines are all the same. You have one number. Okay. So within that one number, you have flex warehouse, you have storage, and you have manufacturing, all in one category, correct?
We have, yeah, there's a wide range without a doubt.
And so how do you account for the differences in the rates of return? It is fair to say that flex warehouse would have a different rate of return than manufacturing, is it not?
I would not argue that. I would say your flex warehouse, you're going to see more of your typical investment type properties. They're going to generate an income where that's the interesting thing about industrial properties is that you have a lot of owner occupied properties that are not renting out. So there is that range there without a doubt.
Okay. I think that's just about, I got one more question here. Now, the rate applied by the model was 6.3. Now, does your model have a way to adjust it for issues such as the high degree of moisture that we observed in the brewery?
No.
And
That
okay.
would have to be like an adjustment by an assessor if they felt it was applicable in a sense. So the model itself can make that adjustment.
And that hadn't been done after your inspection, or do you think that there is room for some change for the brewery component on this cap rate?
I mean, I don't really recall getting too much into that high degree of moisture. They never pointed out any mold that was happening anywhere, deterioration or anything. Is there a lot of water in this property? Without a doubt, they're brewing, but it has a water caused damage. I didn't see any.
What about that loading bay where all the waste is put in? Did you notice the decay on the cement, the staining on the walls?
Well, I mean, that is the loading bay. It's kind of the exterior part of the property in a sense before you leave the property. I know it's enclosed, but that is where they are draining it. So, I mean, I would say that's the function of that part of the property.
Right, but it is a corrosive function, is it, from what you observed? Is that a fair statement to say there's corrosion?
I would say that I don't know if you would need to adjust the capitalization rate for that particular reason.
Thank you. Those are my questions.
Thank you, Mr. Neufeld. Mr. Harden, do you have any questions?
Okay, just to clarify then on that 6,000 square feet vacant space, you feel that now it should be at a lower rental rate?
Yeah, I would not argue that would probably be at a lower rental rate as it's not built out yet. I can't give you an idea what that rental rate should be because I don't have comparables for it. But yeah, it probably should be lower than what it's at due to the fact that you can't rent it at the moment in the state it's in.
Okay, no more questions then.
Thank you. Mr. Tyrion, do you have any questions?
Yeah, well, just a few things to confirm. So I worked out your rate at $9.90 overall, and you talked about mailers being at $10, but I'm just confirming that. Now the vacant piece of 6,000 is the same, and I think my colleague questioned that. Is the same, that's the unfinished portion on page 40?
Correct.
Okay, so the vacancy, and so I just wasn't sure what the size was of the vacant piece. Okay, thank you.
Thank you. And I have no questions. So Mr. Neufeld, you can proceed with your presentation.
I thought questions would be longer. I'm just chewing something. Okay. Thinking about what the assessor had to say on my page 1, I don't really feel that we have a major disagreement with him on the rental value on the one portion being the premise ID ending in 763. We just put the same uniform number on the whole site. Our main issue is that the rest of the site is inferior. the unfinished portion, of course, and the warehousing portion, and then the manufacturing or brewery portion. The rents that are generally derived and applied in many industrial valuations, and I feel the model as well, seem to be focused on this concept of a flex warehouse. And a flex warehouse is a euphemism. It's for building an industrial building that ends up being mostly office. And this part of Kenaston has office or retail. It has many of these. However, in the subject, most of the uses are not. And once again, we do take exception with the capitalization rate, and our calculations are below, and we had worked out what the taxes are per square foot and the utilities and the maintenance. We feel that they're the actual number, because we're dealing with we're not dealing with a property at the lower end of the industrial range. The cap rates, actually the shortfall rates derived by the assessment department seem to come from, at $3.75 a square foot, would indicate a tax load of about $1 to $1.50 a square foot. And the tax loads here are much higher because the rents are higher. Typical rents are going to be $4 and $5. So it's not fair to use one size fits all. The assessment department should have separate parameters. They should be breaking down heavy manufacturing, light manufacturing, warehousing, and the flex ones, because they're all different. But they are not alone in this, because the appraisal world seems to think that they can do it as well. Flex warehouse is not industrial. Investors seek the flex warehouse because it's flexible. If you have a vacancy problem, you can re-demise a wall in short order and change your tenancies around and not suffer. That's why people are building these all across Winnipeg. The subject, with the exception of the building and rear, is not flex warehouse. The vacancy rate we used is on page and it's the same table we looked at earlier, in that and remember, this is an investment vacancy rate, and we're dealing with investment properties. This is a broad range of property types. Many flex are in here, but the Johnson report actually has hundreds of properties in here. And actually, this is a Johnson report, and there's about 10 pages, and they're all listed. And the investment vacancy, 7.2% overall. Fort Garry at 2.5%. Now, Fort Garry does not operate in isolation. The reason the number is so low in Fort Garry is the high degree of flex warehousing in this area, and buildings that are being used for retail, such as 1290 Kenaston, the assessor brought up, which probably shouldn't even be in that inventory. So we're using a blended rate between the overall and the Fort Garry at 4.9%. That's more indicative of what a real industrial building should be getting. And the assessor did a very good job at going through the building. On page 5, this is an original rent roll, and our reason for showing this is that the original lease was drawn up in 1999, and it came out at $8, and that's shown at the top of page 5. But in there was several pages dealing with the recapture of the original construction costs, which included the infrastructure required to service a brewery. This was designed and built as a brewery. So the original lease ran 20 years to recapture all of that. Then the renewal terms were stricter as well. And they are listed below that, what those rents would be on the renewal terms. There is no flexibility. So this is not a fee simple lease. This is a cost recovery lease. So we would look past this to the market to see where this would fit in the market. And the pictures we have are the same ones that the assessor has provided. The ones I was going to point out, for example, page 13 at the bottom is the inside of the brewery. And this is a row of brewery tanks. This is liquid. The floor is wet. The building is wet. There's a high moisture content, which we'll get into later. Page 14, this is one of the refrigerant rooms. And you can see that they use a glycol cooling system in there. So this was in the original development of the building on the cooling systems. Parts of it were included, parts of it were upgraded. The rest of the pictures demonstrate a light manufacturing building. Excuse me. On page 16 at the bottom is a bay where the refuse from the brewing process is stored for a long term. They fill this building with liquids and solids that are then resold. So they fill the trailer up and then it's hauled away. This is interior space. And you can see the top of page 17 is this is what is being stored on premises. Now, the concept of moisture damage is moisture is the building's worst enemy, and it shortens the lifespan. And to say it's restricted to one area isn't fair. It's much like saying that our body, we might only have one poor organ when we need all of them to survive. The whole building is affected by this. And the top of page 17, the pony wall, as it's called on the top picture, is black, and that's not its natural color. But this is what the brewery does. It's wet by definition. The outside of the building on page 18, that large door on the top picture shows the bay that we were looking at. And then the hoppers go through there and into the building. Comparables, when we ended up looking at it, and as I mentioned, I think that our rent on that one unit is on the low side. We just went for an overall rate, and on page 4 we have industrial uses, not flex warehouse, industrial uses. There are a few crossover sites, the same buildings on Waverly that we discussed on the previous appeal. They're about 8 or 9 down, and they do show higher rents. And that might be a bit more indicative of what that finished space, the one unit, should be for. But the rest of the rents we're showing, and that was super light and floor show. The rest of the rents we're showing are all much, much lower. And the some of the highest rents, 1036 Waverly, which I didn't get into. This is an industrial building on Waverly, good location. Retro building is older, but it was redone for this user, and they're a piping company. They make plumbing, industrial plumbing supplies. Very similar, I think, to what you would expect for the brewery, which is a well-located industrial manufacturing at 725. Shared site. This one has a good loading at the back. The difference is that there's a slightly lower ceiling than the subject has, which is why we were looking at the $8 rent. The rest of these rents are, as again, showing a general character of the industrial market for working buildings, not office buildings, working buildings. And a full 2/3 of this site sorry, 75% of the site is best characterized as a working building, an industrial working building, not flex warehouse. And that is the mistake with the assessment department parameters. And I'm very happy we arranged an inspection because it was quite illustrative of the difference between the two. The cap rate we've used, again, I mentioned some discussion about cap rates and differences. In the industrial world, The cap rates for nice flex warehouses, page 53, bottom of page 53, all the market reports you ever see, this is the type of building they're looking at. This is actually the old brewery site in St. James, the Labatt site that was bulldozed and rebuilt with so-called industrial buildings. This is a nice cap. This is a flex warehouse with 6,000 foot bays, 60 by 100 bays that can be changed. With ceilings, you can add a floor. That's why they call it flex. It's a good property. The Terracon properties, good properties. It's what investors strive to see, not breweries. Now, the best comparable we have for this is on page 46. We have a number of industrial sales. Now, the best comparable, we believe, is the subject itself. In October of 2015, incidentally, the sale that the assessor reported is an allocation sale. The entire portfolio sold for $47 million. The entire portfolio was sold from one group, Slate, to another group, Vermont. The cap rate is been done three ways. And you can see the entire page is this particular portfolio sale, including 130 Lowson halfway through. Firstly, on city parameters. Now, to do this calculation, we took the actual paid rent and then we put in the city parameters on vacancy, shortfall, etc. And it capped at 995, which is different from the actual cap. And the reason being is, as I mentioned, the city parameters don't apply. This is a mixed portfolio. Industrial, manufacturing, retail, some office, predominantly all in industrial buildings. You can see the classification codes in the second column. Most all are classified INWWH or INMLM. However, they were a variety of mixed uses. So when we did our calculation, we came to 8.92%. Now, in this calculation was on the top of page 47, a leasehold at 2019 Sargent with a short expiry on its land lease. We took that out because that capped much higher and then adjusted it down to 8.6%. This is a fabulous example of what the site should be looked at, and 8.6%. Additional sales, page 47, have to do with 1535 Seal. Now, this was a sale of the real estate, and the business preceded the sale, and then the owner bought out the lease, 8.29%. Now, there's an allocation in there. The sale was recorded higher, but because there was some manufacturing equipment in it, which we researched and found out what that allocation was, and that's the sale. Another sale, 100 Paquin. This was originally built as a manufacturing site for Temro and sold initially on a leaseback. And then after Temro went Chapter 11 in the US, was backfilled with a water manufacturer whose business was selling bottled water. About 80,000 square feet for bottling water. He rented the site and then he negotiated a sale based on his lease. That capped at 8.47%. And that's about as close as you'll ever see to a brewery cap rate. And I think it's a very, very fair comparison. And we've applied 8.25, and that's due to the better location and the fact that there are some other uses on the site, the flex warehouse on the site. Water is a building's worst enemy, and it shortens the remaining economic life. And remaining economic life is what an investor bases the quality of the income stream on. Facing a vacancy in the Fort Garry site, the ability to reuse the building would either require a fair amount of capital or a redevelopment. So it's going to stay as it is for as long as the brewery usage is viable. But based on an inspection, we know that the brewery world is changing as well, and they're going to be changing what they do. Regardless of that, the cap rate is predominantly based on the brewery, and because that's the largest user on the site. So our value, as I said, I think we should have had some upward adjustment for better space, but we were at 4.5 million. And the sale of the site, the property owner is Wallace and Wallace Fencing, who have two other sites on the street. I've worked for them for about 15 years as they grew and expanded. And James, and I've been working for him on finding more sites for his space for years. His original purchase of this site was to get expanded storage space for his aluminum product that he was manufacturing at 90 Lowson. That's why he bought the site. After that, he purchased 115 Lowson across the street. And then this property became, he no longer needed it for his outside storage, so he looked at other development potential. Original motivation was assemblage, which does not meet the definition of market value, which is why we're not really considering the site, the sale of the site. I acknowledge that the number is vastly different, but the point is that this property, what was never appealed in the past, we'd filed a number, but and I think the last assessment that was in place was at 2.9 million. So there is an upside, and it's for the redevelopment of the land. The assessment before the renovations was 3.9 million, and that I believe was confirmed at our request, as we were aware that a supplemental was coming out, and we didn't have a problem with 3.9. The potential for expansion had been demonstrated and was underway. So this was a property that was going to be hit with an excess land value. And now that the development is done, I don't have a calculation for you, but I think the number strays a bit closer to around the $5 million mark, with a higher rent indicated for 6,000 square feet. That is my presentation.
Thank you, Mr. Muto. Mr. Lobenstein, do you have any questions?
Yeah, I have a few questions here. So you've come up with a value of $4.5 million, and so the original purchase price of the property was $4.5 million. So you feel that these additions have added no extra value to the property?
No. As I said, that's on the basis that the original sale is a valid indicator of market value, and it wasn't. And the point no one has brought up yet is it was a share sale as well. It was not a title sale. Mr. Bueller and I have been working together for years to find more land, and he's gone through several attempts. He's been driven by a business reason. His site at 90 Lowson, he's making aluminum products, is undersized. He wants to stay in the area for transportation, and the big reason is M3. The site is zoned M3. His site at 90 Lowson is M3. The one he purchased at 115 is M3. He needs to be in M3 because he's welding aluminum. So this is what we call an assemblage purchase. Not a lot of weight to be put on the sale price.
You spoke of the economic life and the fact that there is a lot of moisture in the building, and yet your client has still gone in and invested a substantial amount of money in a building that you say has moisture issues. Is that kind of counterintuitive?
No. He spent the money on new accommodations, not on the old accommodations. So the older part of the building, the 29 25,000 square feet that was in place, 25,000 in place, no money was spent there. He spent it on new buildings. So I don't disagree that it's getting some value out of the addition of the new buildings, but not in the old one. And it's half the building is moisture impacted, half the site.
Okay. Just quickly to your page 35, you have a market cap report. Industrial is 6.5 to 7.25. I guess my question is, there's also definitions here on your page 37 of a industrial multi-tenant building, which I feel this particular property falls into that definition of a steel frame, pre-cast concrete, tilt-up panel, 25,000 to 100,000 square feet with 10 to 20 office space. I'm sure everybody can read it. It's very similar to what this type of building is. But that being said, my question more is that these cap rates are 6.5 to 7.25. And then when I look at your cap rates that you've presented, you don't have any in that range at all. Why would that be?
Well, first of all, this information is generally presented as rebuttal because the assessment briefs we get include a fair amount of what's deemed market information. And I note that on your page 25, you have Cushman, Colliers. Reason we're presenting it is we're rebutting in advance. The companies like Colliers and Cushman don't track breweries. We track Flex Warehouse. And it does not fit into what we're tracking because investors don't want to buy breweries. You remember our original investor who bought a portfolio got rid of this right away because it did not fit into a good investment portfolio. He dumped it off and sold it to an end user because it was inferior. And an end user who he was fortunate enough to find needed space to expand his business. A lucky convergence for both parties. The cap rates, the definition, no, it doesn't fit in there. It's a metal prefab building. It's a metal pre-engineered, and it's not investment grade covenant strength. Fort Garry Brewing, all due respect, are not investment grade. We all know, just read the newspapers, how many mergers and restructurings they've gone through in their recent lifespan, starting in 1999. They're now merged with another brewery who brought in capital. Now, when you look at investment grade covenant strength, investors going to say, yeah, I don't want that. That's not investment grade. But yet our reports do. This is a sales brochure, pure and simple. Page 39 also shows you that we calculate caps differently. And on page 39, when our report is properly read, the fact that we calculate that our brokers calculate caps rates with closing costs in them, the actual range is 7 to 8.25, and we're in at 8.25. So that is incorrect on what you were saying. Now, the information, incidentally, on the calculation of cap rates has been presented numerous times, actually by Altus, in both the municipal board and the board of revision. And there was testimony by Don White on that basis, where he refers to the method of Colliers adjusting our cap rates for these closing costs. And so this is not a surprise. As I said, it's mostly just done for discussion of, can you use a market report? And I just went through this at the municipal board where somebody said, where do you get this from? And it is in the public domain. You below per suite, you have plus Manitoba land transfer tax, legal closing costs, CMHC fee, CMHC premium. Those are all costs that you use to calculate the cap rate. Is that correct? Answer, correct. And that's what we're showing on page 39. I'm reading from testimony. So that is the right Collier's range. Questionable whether it fits or not, but in answer, final answer to your question, we actually did stay within the real range. Thank you.
Just quickly on page 5, we're talking about the rent here. The leasee shall pay basic rent. So basic rent would be considered a net rent after expenses.
No, in this case, the basic rent is a cost recovery on the additional infrastructure. When they built it, I think you've got the lease. There was a few $1 million or $1.3 million in costs laid out. At the time, the tenant was directly paying some of them, and the landlord was paying more, some of the infrastructure costs, and then recouping them in the lease. So, and that was called base rent in the lease.
Those are all my questions. Thank you.
Not a market, that's all.
Thank you very much. Mr. Harden, do you have any questions?
No questions that haven't been covered.
Okay, Mr. Tyrion, do you have any questions?
Yeah, did you say you were revising your figure to 5 million?
I did a quick workup on it. It's approximately 5 million with a, I'm agreeing with the assessor's rent on that one unit. Yeah, it's
Okay, that's all I had. Thank you.
Thank you. I have no additional questions. Thank you very much, gentlemen, for our hearing today. And you'll be receiving our decision shortly. And this hearing is now closed. Thank you.
Thank you.